I can't really think of a time when there's been quite this much divergence.
Consumers are pushing back on price, and that's why prices are coming down almost across the board.
High interest costs are finally sinking in. I think we've been impatient with the long and variable lags, but they're coming and they're here.
I would be very, very concerned about a deflation scenario in the U.S. for services.
Is growth going to slow down? Yes, I think so.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together for the next 2 hours with the wonderful, the brilliant TK Mohammed El-Erian.
It's great to have Mohammed El-Erian here really to talk about what's going on in Las Vegas, among other things. We're looking at equities, bonds, currencies, commodities. You know, after what happened to Carlos, Max Verstappen out on the track, practice 2 right now.
I can hear it.
Delayed. They eliminated the fans. The fans can't show up for practice 2. It's almost as big a mess as the shorts call in the market.
Free practice 1, I think Carlos Sainz hit a manhole cover. Is
something
that right?
Like that.
Ripped out the underneath of the car and they shut the whole race down. Tom, we've been talking about this all year. Sacrificing the integrity of the sport for commercial gain by chasing this market in America.
I think it's a Netflix effect. They got drugged by Netflix and all the success of it, and there's now after Netflix and how they recoup from this. Just to get to the serious stuff at hand, John, they're going to do this practice right now, truncated, no one in the stands, ridiculous. Then they open the roads up for Las Vegas commute. And then they have the qualies, which is what I like. This is where they figure out who sits where in the race.
At 3 a.m. in the morning.
At 3 a.m. our time in the morning.
Wonderful.
It's a big success. Why don't we move on to what Dr. El-Erian cares about?
Mohammed, you have a choice. We can talk about this or we can talk about soft landing hopes and dreams. What's your preference?
So let's talk about soft landing. But before that, there's even bigger Las Vegas news, which I'm surprised Tom hasn't brought up, which is that the Oakland A's are moving to Las Vegas.
Big move. It's, and again, this is the changing of America. John, there's a whole demographic skew here, which Mohammed camped out in Newport Beach years ago. And the basic idea here is the attainment of the South and the West. And you look at the demographic studies, I mean, literally back to the important economic demographics, and the names that keep coming up are Nashville, Austin, Las Vegas, and others.
Can I just say that I don't get it? How you take a sporting franchise out of one city and take it to another one, Mohammed. English football, that is just not a thing. Why do we do that in American sports?
Money.
And that's it, bottom line, right?
That's it, stadiums, money.
Well, Peter Seidler dying of cancer tragically here, the owner of the San Diego Padres. His grandfather is the guy that started it. Walter O'Malley one day packed up Arthur Levitt's Brooklyn Dodgers and moved him out to L.A. And that's when it started years ago.
Let's start this program properly with some price action. Let's
do some price action.
Try and move on just in case people get confused and if you think we've turned into ESPN. Equity futures on the S&P 500 shaping up as follows. We're positive here by 0.2%. Yields a little bit lower. We're down 4 basis points, 439. Mohammed, we've got to sit on crude. The idea that crude has essentially collapsed into a bear market, down more than 20% from the September highs. We've spent this week talking about soft landing hopes and dreams. Do we have to start thinking about an economic downturn in the not too distant future?
Well, some people are talking about this. I mean, to see oil prices down more than 20% from the highs at the time that there's a conflict going on in the Middle East is quite astounding. And that's feeding into the soft landing. And we're going to talk a lot about this, but the market has now fully embraced, not just that the Fed has finished its hiking cycle, which I think is correct, but that we're going to see deeper and deeper cuts next year without a recession. And that's the critical assumption that's now built in across markets.
I want to get the money question out of the way right away. A CEO of a major 2 million employee company in America called Walmart yesterday brought up the D word, deflation, seared into the fabric of Cambridge, Oxford, and the London School of Economics as a study of British deflation of the 30s and 40s. America's never faced that, have they?
They haven't, and we've had Japan recently. And the problem with deflation is it discourages people from buying today. However, I want to stress, the U.S. is deflation in certain products, food being the primary example, and that's why Walmart really cited it. We don't have general deflation, and I doubt we're going to have general deflation.
I mean, I look at the general deflation question, and it is a vector of disinflation in place. Clearly, we see that. What is your optimism of getting back to John Williams' 2.0% or Richard Claridge's 2.x%?
I think Richard is more likely to be right than John. I think we're going to get stuck in the high twos, and the Fed is going to have to make a very difficult decision. Does it live with inflation higher than target because the target itself is too low? Or alternatively, does it acknowledge that 2% is the right target and then crushes the economy? I think that's the choice the Fed is going to have to make.
What's your best guess right now?
I think it's going to go for the former. I think the Fed will understand that pressing 2% inflation in a world where there's insufficient structural supply is not the right thing to do.
So where do you think it leaves this bond market? Let's go through the scores right now. We've got a 2-year at the moment at about 480, a 10-year at about 440. Think about where we've been in the last month or so, Mohammed. We've had a 2-year pushing 525, highs of the cycle, 10-year through 5%, highs of the cycle. How are you thinking about what we come back down to, bearing in mind what we're pricing for rate cuts next year?
I think we've come down too far, to tell you the truth. I understand why some people think that we're going further, but if you look at the inflation dynamics, that's harder to get, unless we go into a recession. If we go into a recession, then the stock market is mispriced. So you can't have both at the same time.
Has something changed? I think this is what it goes back to. Has something changed post-pandemic that means we don't go back to the pre-pandemic world? That debate, I think, is still ongoing, Mohammed. Where do you come down on it?
I think the pre-pandemic world was exceptional. It was a world of QE. It was a world of insufficient aggregate demand. And when you have insufficient aggregate demand, you can push into the economy as much liquidity as you want because you won't get inflation. That world is gone. We're in a world now of inflexible supply. And that's a very different world.
Something to talk about over the 2 hours with you, Dr. Alarian, is growth economics. I've been telling a lot of people to remind themselves of a guy named Solow at MIT in 1956 and the near religious experience of trusting in growth. Can you state that we have a new American growth economics off what some people are indicating is improved productivity, improved efficiency?
So, I listen carefully to our friend Mike Spence, the Nobel Prize winner, because he spent so much of his career studying growth.
Studying with John Hicks. I mean,
Correct.
The majesty of that alone.
And he's incredible, and his insights are really valuable. And his bottom line is that most countries have to evolve to a new growth model. The U.S. is the most advanced in that evolution. I think the 3 important pieces of legislation that the administration passed last year were critical in that perspective. So if you look around the world, whether it is the U.S., Europe, or China, all 3 have the challenge of evolving their growth model, and only the U.S. is doing it seriously right now.
Are we too gloomy?
No, Lisa isn't here, so we're not too gloomy. Okay. No, I think we recognize that the world is evolving. This is a different global economy. This is a different domestic economy, and policies have to evolve accordingly.
What worries me, and I think the concern of a lot of people listening to this conversation ongoing at home, is you just have to go back 48 hours and we're talking about disinflation, soft landing hopes and dreams. And then 24 hours, 48 hours later, you look to Burberry, a collapse in luxury. You look to Walmart, a warning about the US consumer. You look to crude entering a bear market. And all of a sudden, we're talking about a slowdown and maybe even recession. Mohammed, the bond market's stuck between all of this. We're seeing double-digit moves day after day in either direction. You've written about this extensively in the last few months, about a bond market that's lost its anchors. Is an economic slowdown sufficient to regain some stability in fixed income, in Treasury specifically?
No. I mean, I was really struck yesterday. I was watching you when you said, guess what? We're at the same level of the 10-year as we were a week ago. And my reaction is, how could that be? So I looked it up, and you were right. Now, most people feel that this week is very different from last week because of the inflation print that we've had. We still lack one of the 3 anchors. You either need an economic anchor, or a policy anchor, or a technical anchor to the bond market. And we've lost all 3. So these moves are going to continue. The thing that has really impressed me is that nothing has broken. If you had told me a year ago we're going to see this incredible volatility in the most important market in the world, it's the benchmark for so much else, and yet nothing will break, I would have said that's impossible. So the resilience of the functioning of the market has really impressed me.
The financial system, and of course we had the shock in the United Kingdom off a derivative structure in the pension plans, but to lead to this and measured in standard deviations, which is how fancy people like Alarian think, we had a 6, 7, 8 standard deviation end of the Great Moderation. There's a hope and prayer we get back to that trend line. That's in years. How many years out do you think we heal this great bond debacle?
I think it's going to take time. Remember, we've had 10 exceptional years where the bond market was distorted.
Some would say back to Volcker, we've had 30 exceptional years.
But the shift to an artificially low interest rate and ample and predictable injections of liquidity fundamentally changed the bond market. And that is going to take time to recover from.
Did you and Bill Gross get a free ride because you were within the Great Moderation? Oh. Was that such a structural
I'm not sure it felt like a free ride at the time.
No, it didn't feel like a free ride. But did PIMCO, when you built it, you invented it with Bill, was it easier because you had the Great Moderation?
Just think of investors. Investors care about three things: returns, volatility, and correlations. And we went through a period that because liquidity was being injected into the economy over and over again, we got high returns, we got virtually no volatility, and the correlations broke down, but in your favor. You made money on your risky assets and you made money on your risk-free assets at the same time. That was a great time. We took it to be normal, but it was truly exceptional. And we're going back to a world that I think is more like what we had before the global financial crisis.
It's going to be so hard to shake this, Mohammed, because we've got a whole generation, in fact, a couple of generations conditioned by two major shocks, the financial crisis and the pandemic. And we know how the Fed responds to major shocks. What we've all forgotten is how it responds to just normal economic downturns and upside pressure on inflation. How do we start to get into that all over again?
Yeah, and this is where Fed credibility and better communication is better. John, it's really striking that the market is willing to take on the Fed on a price that the Fed controls. The Fed totally controls the policy rate, and yet the market does not believe what the Fed is telling us. And it is really striking because we have got to restore Fed credibility. Otherwise, we're going to continue with this enormous volatility.
Your thoughts on what's percolating into the end of the year and into Q1 2024? Are there shadows in private equity? Are there shadows in the new non-traditional finance?
Yeah, so one thing that I don't think is priced in enough is that when you move from the banking system to the non-banks, you change the lags in the system. So you see this with commercial real estate. Everybody recognizes that the refinancing of $1 trillion plus of assets is going to be tricky, but because it's over time, we don't worry about it. Everybody recognizes there's a maturity wall in the corporates out there, but because it's over time, we don't worry about it. If it were all within the banking system, we would have worried about it really quickly. So the move from the banks to the non-banks has extended this
and
time.
This is a Michael Spence issue. The regulatory lag here is tangible.
This is that uncomfortable calm, though, as well. Just to borrow that phrase from a long time ago from the Bank of International Settlements. This maturity wall is out there in 2025, and there's just this feeling, Mohammed, that we don't have to think about it. But at some point, we have to start thinking about it, don't we?
Right, but you know what? You enjoy the journey before you get to a destination.
Oh, here we go.
And
you want to give us some good news, bad news? Bramo's not here, please.
No, I totally understand, because momentum is really important, and you want to be exposed to this market. And I think most people have much more of a tactical mindset than they do of a strategic or structural mindset. And investment has become very tactical.
Mohammed, setting the tone for the next 2 hours. It's great to have you with us, by the way. This is going to be great. For the next 2 hours, a fantastic lineup of guests. In just a moment, we'll catch up with Steve Cheverone of Federated on the equity market, looking out the next 12 months. Coming up later, tons of Fed speak. Collins, Barr, Daly, Goolsby. TK, what do you expect to learn today going into the weekend?
That they should speak less, I think would be helpful. And, actually, Austin Goolsby, I think, is fascinating here because he comes from the Chicago behavioral social science nexus. And I think he's very attuned to what are the ramifications of policy much more than others.
Daly said it earlier this week in the Financial Times. It's too early to declare victory.
Love it to death. Everybody's got a different story. Her life story makes her a good Fed president.
Equity futures on the S&P just about positive by 0.2%, trying to get you towards the weekend, towards a third week of gains on the S&P. Yields lower by 4 or 5 basis points. It's a break of 440. On a 10-year. What a turnaround over the last month. Your yield this morning, 4.38. From New York, good morning.
We still don't know a lot of things. We don't really know if how tight monetary policy is. We don't know how long it's going to take to get inflation down to 2%. So I think the degree of uncertainty and risk is a lot less today than it was, say, 18 months ago when the Fed started the tightening process. But there's still a lot of uncertainty about how strong the economy can be and whether the Fed is done.
Former New York Fed President Bill Dudley there on the situation in the market. Fixed income, hopes and dreams of a soft landing and disinflation without the pain of higher unemployment. Fed officials and anyone in and around the Federal Reserve basically saying the same thing all week. It is too premature to make that call right now, to make that declaration of victory, Tom, over inflation.
Yeah, the transitory thing is tentative, and there's a lot of other things tentative. And guess what? They're a new kind of data dependent. I can't emphasize enough the ex post natures. As you know, John, I'm boring you. I'm particularly focused on Japan, Euro Yen 164 to 162, maybe a first good glimmer for UEDA. But the answer is they're all slaves to data dependency. And after this week that we've had, that new attention to data dependency has increased.
If you're waking up early Friday morning, good morning to you. Here are the scores right now. Equity futures on the S&P positive again. 3 days of gains on the S&P 500.
Still haven't jumped in.
Here's another lift, up by 0.2%. Potentially a third week of gains going into the weekend. Bonds rally and yields lower by 4 basis points, 4.39. The euro stronger again, 108.71 against the dollar, positive by 0.2%. Crude bouncing back, but this has been the surprise ever since October. You get some tension in the Middle East. We start talking about triple-digit crude, bang, back in a bear market on crude, Tom. Just a shocker over the last 6-8 weeks.
To the end of the year, Edward Morse of Citigroup and the Council on Foreign Relations
agreed.
Absolutely nailed it, and it was as lonely a call as Dudley and Elarian and Anna Wong of Bloomberg Economics a zillion years ago. Maybe I'd throw Hollenhorst in there as well.
Christian Malik, your good friend over at JP Morgan on the energy desk out of London. This is what he had to say in the last 24 hours.
Please.
We could see OPEC Plus do sizable cuts from here. I think it's more likely they'll want to stabilise them among their OPEC peers, a collective cut, rather than one on their own to get ahead of the economic weakness maybe going into next year.
And this ties into Jay Pulaski in the next hour, where Malik was looking for EM expansion to boost demand, and it, for whatever reasons, I'm not faulting Malik, but it hasn't happened. So there's the JP Morgan readjustment.
To your point, the bulls have been wrong. Brent crude's back in the 70s, WTI is threatening to break into the 60s.
Right now with us, and to have Mohammed Elarian with us is a great thrill today. He is at Queen's College in Cambridge, and he's interested in the asset allocation of their endowment. That's the campus of Steve Chivarone, head of multi-asset solutions at Federated Hermes. Steve, this is a lonely bull market. How do you reallocate into the end of the year?
Well, you had to get ahead of it a little bit. We were adding over the course of the summer when it was uncomfortable on the idea that markets like Fed pauses, and they price in soft landings, even if a soft landing doesn't materialize. Because when the Fed pauses, invariably, it's on suspicion they've gone too far, not on confirmation. And so the data that's available to you is a Fed that's no longer hiking and an unemployment rate that's still low. And that's been the case throughout history, and it's the case today. And so finally, with the bond market having broken, we're getting that Fed pause rally, and that can be powerful, Tom. You know, historically, those are 9-month events, and you can see the equity market up 15, 20%. And interestingly enough, and this is something that's been on our mind, the equity market has hit an all-time high each of the last 5 times that the Fed has paused. Now, 4 of those ended in tears, but it still happened either way. And we think this rally has legs. I think the jury on whether or not, how soft this landing is next year is still very much out. But for the time being, we think this rally continues.
Steve, what are you looking at to determine this whole macro question of, has the Fed not just paused, but it's going to start cutting? And can it do so within a soft landing? What are the key variables you look at?
We're calling them the 5 games of chicken. And it's that corporate refinancing wall. You're going to have about 60% of corporate debt come due between 24 and 28. So what percentage of that is going to face materially higher rates, and what does that do to company earnings? That's number one. Number two, for small businesses, they've already seen their debt reprice because it's variable rate bank debt. So how many quarters of high rates can they survive? On the consumer, real income growth has finally turned positive, but how positive does it get? And does it allow a consumer to delever again, rebuild savings, and continue to spend? $877 billion of bank deposit outflow. What does that do to restrict lending? And then what percentage of the federal debt, a third of which becomes due this year, reprices to a significantly higher rate. Those 5 things, we think if they were to all go perfectly, you'd get this immaculate soft landing. We think that's unlikely. We think what's more likely is a kind of rocky landing where inflation stays stuck at 3, rates stay high, there's some slowdown, and it's a kind of malaise. It's a single-digit equity environment with a real risk that something breaks and you get into a classic recession. So it's really between that rocky landing and then a kind of a classic recession break that we think is most likely to happen. We're in the rocky landing camp, at least for now.
And what do you say to those who say of your 5 factors, it's 1 and 5? It's all about supply. It's all about who's going to buy all the supply.
I think that's big, but where I would focus more acutely is on the nexus between banks and small businesses. The banks, again, if there's $877 billion less of deposits, that's $877 billion less of loans that can be made. And small businesses are reliant on that, and they're not facing a maturity wall. They've already seen it. And so if something's going to break, we would look there. So we're spending a lot of time focused there. It also has us biased towards larger cap companies within our asset allocation.
Steve, let's get to the quote that shook up this market in the last 24 hours. TK talked about it at the start of the program. It came from the Walmart CEO. We may be managing through a period of deflation in the months to come. Steve, when you heard those words yesterday, what was your response?
I think the word deflation is probably a little strong, but I do think that there could be a lot more disinflation than what we're expecting. If you look at the areas of the economy where you've seen disinflation so far, it's goods prices, it's food prices, it's energy prices. It's a lot of stuff that, quite frankly, can be explained by COVID normalization. Big interest rate sensitive purchases have not really seen the big deflation that you'd expect. Right? I mean, home prices are still relatively buoyant. Go and try to buy a car. It's not exactly a value exercise these days. And so I think as the rate hikes filter through the economy, there is more disinflation in the pipeline. And I think you could see a Fed at some point in 24 go very quickly from worrying primarily about inflation to worrying very much about growth in the employment markets. And that could switch on a dime. And it's something that keeps us in a kind of humble position.
Well, Steve, to that point, is the same true for investors, just to jump in? You mentioned there that the Federal Reserve can make that switch. I just wonder how quickly investors start to make that switch and whether we can get some divergence between what's happening with bonds and what's happening with stocks.
I think what you do is you pull up some charts and you look at them historically. Unemployment takes stairs down and elevators up. The equity market takes stairs up and elevators down, particularly if you are headed towards a recession. You don't gradually shift your view in the late part of a cycle. It happens very, very swiftly. And that's why as an investor, you have to prepare for that. You start to lengthen duration. You start to upgrade the quality of your equities. We like companies right now that have strong balance sheets, strong cash flow generation, low external financing. And you move in that direction so that if it does move on a dime, which historically it does, you're not left out in the cold.
Steve, wonderful to get your thoughts. It's good to catch up. Have a good weekend, mate. Steve Chevron there of Federated Hermes. One of my favourite notes comes out weekly on a Friday morning from Michael Hartnett of Bank of America. He had this to say this morning. Essentially, lower yields are good for risk assets until they're not. It gives you a range of numbers here, Mohammed. 5 to 4% bond yields, bullish risk, easier financial conditions. 4 to 3, different world. He says bearish risk, we'll be talking about recession. Do you think that's the right way to frame things?
I do. I think actually that's a really good way because we all agree on the effects of lower rates and lower oil prices. However, the cause really matters. And if you see rates come down too rapidly, the market is pricing in a major slowdown, and that's not good for risk assets.
A must-read of 2009 had a chapter on a guy named Al-Arian and a chapter on a guy named Michael Maboussian when he was at Credit Suisse. Michael wrote an essay 20-plus years ago on the concentration of technology, the concentration of return in capitalism. Is that where we are now, that the call, and we're going to come back, John, and talk about this, it's so important. Are we going to just see a continuation of the Magnificent Seven as Maboussian?
I think it's a really important question, Tom. Yeah. Going into next year for the stock market, particularly given the surprise we've had this year.
I think it's key.
They've just dominated in a way that I think was unexpected for many. Equities right now positive 0.2% on the S&P. Simon French and Panmure Gordon coming up next. 3 days of gains on the S&P 500. Let's see if we make it day 4 going into the weekend. Equity futures look like this on the S&P, the Nasdaq, the Russell. The small caps all week, all over the place, up by 1.3% this morning. The S&P up by 0.2. Close positive today. A positive week of gains once again by more than 2% currently through the close on Thursday. Incidentally, 3 weeks of gains on the S&P 500 would be the longest weekly winning streak. TK, going back to the end of July, you mentioned big tech. You want to talk about big tech and the Magnificent Seven? David Costin of Goldman Sachs. This is what he had to say in the Outlook. The massive outperformance of the Magnificent Seven has been a defining feature of the equity market in 2023. Goes on to say, the stocks should collectively outperform the remainder of the index in 24. Tom, this is something you talked about a million times. Faster expected sales growth, higher margins, greater reinvestment ratio, stronger balance sheets than the other 49.3.
I can't believe I'm saying this on November, whatever it is. I don't have a concept for next year. I'm 99% certain it's going to be the probabilistic narrowness of the street and believing the Magnificent Seven will continue to dominate. Many people saying, no, it's going to be this, it's going to be that. And I'm just saying possibly baloney. I'm not there yet.
S&P just about positive.
I'm distracted. You know.
I'm distracted too. Let's turn to the bond market. 2-year, 10-year, 30-year. Looks like this. Just amazing to see the 10-year here. It's not a typo. It's a break of 440 on a 10-year. In the last month, we've been through 5% and now back below 440. Mohammed, 439.46, and we're down 4 basis points. It feels like just a normal snoozy day as a 5 basis point move now. Is that the new normal?
It has been, John. It's been incredible. We've had 10 basis points move up and down. It's been this amazing volatility for the most important market in the global system.
Feels like a penny stock, TK. Some days, 10, 15, 20 basis point moves on very little information. Think about Tuesday. Tiniest downside surprise on CPI. We're talking 10 basis points on a monthly read, Tom, and we're moving 20 basis points across the curve. That's nuts.
We got to stay on schedule here. But 10-year real yield, 2.15%. 2 standard deviations moving that, John, is to 2.07. If you have the 10-year inflation-adjusted yield break below 2.07%, what quality of disinflation/deflation does that signal? And weaker demand.
Big conversation for us this morning. Let's turn to our top stories. Under surveillance this morning, President Biden signing a stopgap bill to expend government funding into early 2024, avoiding a government shutdown for now. Despite the agreement, both sides remain divided on a number of issues, including Ukraine, Israel aid and immigration. The measure setting up 2 funding deadlines. Here are the dates. January 19th, February 2nd. Mohammed, the showdown on the horizon, the mother of all arguments over spending.
Yes, absolutely. But the good news, John, is we find a way to kick the ball, okay, and that's fine.
Kicking the can down the road, TK.
He's giving radio answers.
Hey?
You know, he's giving short radio answers. You know, you can continue.
I think he's distracted by
the presence of the two of you. I think people would rather listen to you than to me.
Oh, Mohammed, come on.
So I'm just the transition.
I think TK's typing's distracting you. Is that what
My
it was?
typing, I got too much going on here.
What's happening?
Oh, nothing. We got to do the under surveillance a bit now. We'll get to it. It's, important stuff here. Guess what? January.
Yeah.
We get through the holidays. Do you take the fake tree down?
I take the fake tree down the first week of January.
There you go. First week of January.
After my birthday in the new year.
De-fake tree, and then we got another shutdown. All they're doing is moving the can down.
But where does the fake tree go?
In the living room. You've seen the fake tree.
No, once you take it down.
It goes into storage.
Storage. Deep.
It goes into storage.
It's underneath the subway.
It goes into the cloakroom. You know, the little cupboard by the front door.
Oh, very good.
Yeah,
There's storage in New York? There's storage in New York?
It's the one cupboard we have, Mohammed.
Okay,
that's where the tree goes.
Mohammed's ruder than Lisa. We got to ask, does it have lights or no lights?
It's got lights, yeah. It's a Home Depot job. It's got lights.
AC Milan, red and black.
No. Clear.
So hold on, built-in lights? Or?
Yeah, built-in. Yeah, built-in lights. You're so jealous of my tree. Every year you do this. Every year. I'm going to share a picture.
I'm doing
He's got tree envy.
The prep school donation for More Money Than God, and I got the ugly lights like Bill Gross has.
That's classic. That's classic virtue signaling. That's all I expect from you, to turn up at school, write a big check, then go home, and the tree sits there. I know this for a fact. The tree sits there in the corner and doesn't get decorated until the late
December
hours
23rd,
Christmas Eve.
The kings
Let's get to this story.
Horizon.
Let's move on. Chinese President Xi Jinping saying he'll take heartwarming steps, that's an actual quote, to attract foreign capital to his country and create a world-class business environment. In a written speech at a CEO forum in California, she's saying, quote, "We will also take more heartwarming measures, such as improving the policies on entry and stay of foreign nationals in China. All this is designed to make it easier for foreign companies to invest and operate in China." Mohammed, in a minute, the data point, I think, in the last couple of weeks, to see foreign direct investment into China turn negative. Are those quotes enough to turn that around?
No, words are not going to be sufficient to turn this around. He's going to need much more than words. And what he's going to need is consistency. People now cannot predict the policy reaction function in China. And that's critical if you are an investor, let alone a foreign investor. So he's going to need a lot more than words, John. This
was the charm offensive, TK, we expected.
Yeah,
this was it, but to Mohammed's point, it's not sufficient.
Yeah, to me, the arc into not only 2024, but 25. Dr. Alarian, would you suggest that the critical point for them is to bring some form of capitalistic structure back to Hong Kong? I mean, they trashed Hong Kong. Do they need to bring it back?
I think it's way beyond that. I think they need to evolve their growth model. They need to stop pulling everything up to the top, push it back down, let the bottom-up forces act, and critically understand they need to transition to a consumer-led economy. This is hard, but you will hear people say without that, they'll get stuck in the middle-income trap.
And we have talked about a consumer-led economy since Jonathan Spence was a young man. It hasn't happened, has it?
No, because part of a consumer-led economy is to give up control, and that's the hesitancy. So they have to evolve this, and they're scared about two things. They're scared, one, of losing control, and two, they're afraid that this will come with some type of corruption. So that's why they're going slow. So they'll talk about high-quality growth, but they're not actually putting in place what's needed for high-quality growth.
These are huge challenges. Just before we get to our next guest, I want to squeeze in this story. All the hype around the Las Vegas Grand Prix for Formula One. Here's the drama. Tempers flaring after organisers cancelled the first practice session after just 9 minutes when Ferrari's Carlos Sainz badly damaged his car driving over a loose manhole cover. Ferrari team principal Frederic Vasseur saying, quote, "We had a very tough FP1 that is going to cost us a fortune. It's unacceptable." Toto Wolff of Mercedes, who we caught up earlier this week. Tom, we've talked about this time and time again. Is Formula One sacrificing the integrity of the sport, chasing commercial objectives in the United States of America? Listen to Toto Wolff. They're going to seal the drain covers and nobody's going to talk about it tomorrow morning. Well, hello, we're talking about it. It's completely ridiculous. You're speaking about a drain cover that's been undone. This has happened before. That's nothing. Tom, it has happened before. It has happened before, back in Azerbaijan several years ago. But ultimately, this is what we've feared all year. You chase this commercial gain, you go to places like Las Vegas, and you end up in situations like this one.
I'm going to say this, and it's not nice, and I'm probably inappropriate, but the risk is there. I'm watching this on TV right now. Alonso just missed turn 12. Other people have missed turn 12. This course is brand new, and for the safety of the drivers, that's not good.
I think we all wish it the best of luck over the weekend.
Yes.
We hope it's a successful run of things over in Las Vegas, but certainly, TK, big challenges.
We will see, and we will continue here on what we do: equities, finance, investment, international relations, bringing all that together at Pamir Gordon, Simon French. Beautiful essays from their chief economist. Simon, what are you going to write about into the weekend, into Monday? We've got deflation out there, we've got weaker demand, we've got different dynamics, and I got a stock market to the moon. How do you synthesize that together?
So I was listening to your conversation about 5 minutes ago, the idea that US 10-year treasuries are trading like a penny stock. But there's parallels, aren't there, with that and the Magnificent Seven and the story in equity markets? And how do you pull those two together? I think we're seeing huge pro-cyclicality in pricing in capital markets, not just equity markets, but bond markets as well. And I think it's perhaps not a sort of short-term trading idea or a point of near-term directional impulse, but for the financial stability point, the health of our capital markets, allocative efficiency, the type of, if you like, the social good the capital markets do, is it a good idea that your cornerstone pricing asset in the Treasury market and such a sinkhole for equity capital is behaving like that. I don't think it is, and I wonder whether regulators want to, given all the other challenges on their plate, get into a debate of decomposing why these big asset classes are trading like that in terms of what that does for financial stability, economic growth, allocative efficiency.
A broader question then, Simon French, as you write of often, can the capitalists get on the same page with the people in 2024? Particularly after what we witnessed in San Francisco, they seem to be a bit removed.
Look, the social license of capital markets is very, very important, and I think, look, there's been quite a lot of, particularly in the United States economy post-pandemic, some quite encouraging redistribution, some reduction in those in poverty levels, but that's largely been the response of fiscal policy post-pandemic. And again, sort of taking it back from the near-term call to what we've learned about a response to a big economic contraction and the nature of fiscal transfers and what that does to growth and redistribution. I think there's now a really big divergence emerging from the experience of the European economies and the US economy that I think will frame responses to financial contractions, economic contractions for years to come.
Simon, imagine a regulator calling you after this interview and saying, I totally agree with you. The volatility in the bond market risks financial stability. Tell us, Simon, why has it happened and what can we do about it? What would you say?
Well, I think regulators for a long time, and this is a bipartisan comment, it isn't aimed at any particular regulator, have taken quite a consumer-centric approach to how the ultimate end investor allocates their capital. It's a reduction in fees, it's a preference towards passive allocation, which generates, in my views, more pro-cyclical pricing and it heightens financial stability. So we have to, I think my response back to the regulators said, this isn't a free lunch. Yes, you are undoubtedly generating more consumer surplus for the end saver, but are you potentially introducing more financial stability risk? Yes, you are. Are you happy with that trade? If you're not, you need to vocalize what you're going to do about it, because ultimately that redistribution of the consumer surplus is the way to lean into it.
Okay, so I continue with you, Simon, and say, oh, you're just a worrier. Just look at the amount of volatility we've had and nothing has broken. The system is resilient. What would you say?
I'd say to say that nothing has broken, given some of the turbulence we've seen in terms of money market funds, earlier in the year the sort of banking system being really stretched and stressed in the US economy. There are signs aplenty that this isn't a healthy backdrop. Now, the fact that we've averted through the relatively rapid response from both the corporate sector and regulators, that doesn't mean that the risks have gone away. Maybe we've been lucky, but how long do you want to stay lucky? I think you need to be ahead of these debates rather than constantly being reactive to these events.
Simon, appreciate that response. Thank you, sir. Simon French there, Panmure Gordon out of London. Simon's right, Mohammed. Surely things did break. Some big banks went under this year. I know we moved away from that pretty quickly. It was back in spring, which feels like a lifetime ago, but things broke, didn't they?
But they broke in a very contained fashion. I think the big issue that we don't talk is that we changed the system in an emergency. We have indeed extended deposit insurance to all banks, to all deposits.
Let me get up and give a lecture here. This is from Queen College in Cambridge. I'm a visiting lecturer today. This was nothing more than a bailout of the fancy people. The banks that went under were nothing more than marketing concepts for the haves, the rich people, the rich guys, and we use the institutional insurance. I would love Spence on this. The institutional structure to bail out the rich guys.
But once you bail out the rich guys, you've got to bail out everybody. And that's how we've changed deposit insurance.
Right.
That's been a story of this year. 440 on a 10-year. Coming up, Stephen Schork of the Schork Group. Not on the surprises in the bond market, but on the surprises in commodities, with crude at 73.93 on WTI from New York City. Good morning.
a lot of the inflation impulse on the way up was from higher oil prices. Oil prices have come back down. Commodity prices are under pressure. But if we imagine a scenario where China actually gradually comes back to strong growth, the U.S. stays resilient, I think we're going to have to be a little bit higher for a little bit longer.
Maybe a little bit longer. Higher for longer. Bill Winters there, Standard Chartered CEO, speaking with our very own Haslinda Amin at the Singapore FinTech Festival. If you are just joining us, welcome to the programme. Equity futures on the S&P 500 looking a little something like this. Positive again by close to 0.2%. 3 days of gains could help us get to 3 weeks of gains on the S&P 500. Yields are lower by 3 basis points on a 10-year. We had a brief break of 440, back above it right now at 440.82. We're going to talk about crude in just a moment at about 74 on WTI. Let's get to one name in the pre-market, shares of Manchester United. A report from Sky News dropping in the last hour that finally, because I feel like I've been talking about this for ages, that Sir Jim Ratcliffe's Ineos Sports could announce a deal to buy 25% of the club for about $33 a share early next week. TK.
I look at it as an amateur. I mean, you guys are pros at this, but the answer is Mr. Rashford looks awful lonely out there. Like they need...
You're talking about the team.
They need a rebuild with their new owners.
He was on the bench for the last game.
Yeah.
He's not been playing well at all.
Who's he got to play with?
That's the problem.
Yeah.
They've been spending a lot of money as well.
I mean,
the Glazers have taken a lot of criticism for how they've run the club, and I understand that criticism and where it comes from. But ultimately, they've spent a lot of money on players, Tom, that just haven't got it done. That club just looks rotten on the pitch and off the pitch as well.
Why buy 30%? You don't get control.
It sounds to me, Mohammed, that they didn't want to sell the club to the Qataris, that the Glazers still wanted to retain a big stake in all of this. I do wonder what Jim Ratcliffe can do, whether he has a big say in all of this, Mohammed, on just the sporting side of the business in a way that maybe the Glazers haven't.
I'm going to point out right now, one of the highlights for Bloomberg Surveillance this year worldwide picked up like no other interview we've ever done. John Farrell with the gentleman from the Tots. That was really fascinating.
Daniel Levy of Tottenham.
In real time.
Yeah.
I just got to get this in right now. Now, we got Quali's. Alonso out at turn 12. The Ferrari doing quite well in P2. Quali's 3 a.m. here in Las Vegas.
I'm sorry, it's ridiculous.
Quali's in Rome as well.
Okay.
And the uproar in Rome is that the North Macedonians are not showing up as tourists this time.
It's
qualifying
for the Euros, and Italy once again.
Is this the second game?
They need to know this is the group stage. They've got 2 games left, and they need to beat North Macedonia.
So if North Macedonia, it would never happen, but if they were to defeat Italy, it's one and done?
We'd be 3 points behind Ukraine, I believe, and
John,
we're playing Ukraine.
Can you remind the audience why this is so painful for you?
Oh, thanks, guys. Appreciate this. I thought it was between friends. North Macedonia kicked us out of World Cup qualifying not too long ago. Okay? All right? Do you want me to carry on working here?
Let's carry on right
walking
now.
away.
Well, it's just suspect to say the least. Stephen Short,
Brutal.
principal of the Short Group, saves us now on oil disinflation. Stephen, how does New York Harbor adjust to oil deflation? All the little itty-bitty things, jet fuel, diesel, distillate, how do they adjust to this collapse in oil?
Yeah, it's a really interesting question, Tom. We're trying to figure it out as we speak right now. When we look at the spread action between gasoline on the forward curve and inventories, seemingly there is enough oil or enough gasoline in New York Harbor. And New York Harbor, just want to point out, is important because that is the delivery hub for the mercantiles, diesel and gasoline contracts. Now, when we look at overall supplies relative to demand, we're looking at about 24 days worth of supply of gasoline. Now, that is normal. That is spot on to the 5-year average, and it's slightly above a year ago. The problem now is that traders are skeptical. They are pricing in a premium on the front end of the curve, which is a clear signal that someone out there is concerned about these supplies, regardless of the fact that we do have all this days worth of supply. The other big issue here is jet fuel. Right now, we don't have enough. Jet fuel stocks are extremely low. And as we look forward to next week, we expect this, or I should say AAA expects this to be one of the busiest travel seasons for Thanksgiving of the past 20 odd years. So when we look at the rising demand, when we look at the spread action, something here is afoot. It doesn't line up that the spreads are saying one thing, i.e. there's not enough supply, regardless of what we're actually seeing in the weekly inventory reports from the EIA.
So, Stephen, the Saudis are frustrated with the price action, as you can imagine. I just wonder if they're frustrated enough to change policy again. Do you think they are?
Yeah, it's really interesting, and it is really conundrum that, to be honest, I am perplexed that the market never really priced in any sort of risk premium with regard to what is happening now in the Middle East. And let's be clear on this. This is a war not between Israel and Hamas, but it is effectively a war between Israel and Iran, given that we're fighting, that is to say, Israel's fighting Hamas, Hezbollah, and the Houthis, all backed by Iran. Now, that is a pretty scary proposition with Iran's ability to halt the flow of oil coming out of the Persian Gulf through the Strait of Hormuz. So, yes, there clearly is a head scratcher here that we have this huge risk on supply, but the market refuses to price that in. Regardless, we're focusing now on the demand picture. And yes, if you're Saudi Arabia, if you're Texas and you are trying to produce and you're looking at this price action, yeah, you are frustrated at this point. But I want to say here, based on our modeling, we're likely at the bottom of the market right now, given the situation around the globe and the imbalance now between supply and demand.
So, Stephen, do you think that the Saudis will wait this out? Or do you think the Saudis will be on the phone to the Russians and any other OPEC Plus member that's willing to participate in another cut in production?
Yeah, I do think that there is a concern that we'll see further cuts. Already, the Saudis, Russia have extended their cuts, voluntary cuts, to the end of the year. But we've seen now in oil prices, unlike the product prices, we've seen an absolute collapse in the front end of the curve. So we've now actually, on the NYMEX, we moved into a situation called contango, meaning that prices for nearer-term delivery are now below that of prices for longer-term delivery. So this is a clear takeaway that right now, from an oil standpoint, fundamentals are extremely weak. And I would suspect that we'll see, the chances are going into the quarter, OPEC Plus either extending the cuts or increasing those cuts into the new year.
Stephen Schork, over the arc of Bloomberg surveillance, 20 years, one of the great shocks has been America's success with hydrocarbons. Into the new year, are we energy independent?
No, not at this point. Now, I want to point out that we were energy independent a few years ago. And keeping in mind, energy independence does not mean we do not have to import a BTU from anywhere around the world. We were a fluid trader in the world. We were the dominant crude oil producer in the world, and we were the swing producer, that is. So for all intents and purposes, we were energy independent when it comes to hydrocarbons, and that is just a shout out to how efficient the industry has grown over the past 15 to 20 years. But given current policy right now, no, we're not energy independent. And going into the new year, the big risk is that we are playing a zero-sum game. That is to say that we are taking off dispatchable BTUs, natural gas, nukes, coal, faster than we can replace them with renewables. That's not opinion. That is fact. The regulators are telling the government this is so, and yet the government is still going ahead enforcing these retirements where we don't have enough power. So everyone out there, get used to this and get ready. There's going to be a huge jump in volatility over the next 2 years, a huge jump in pricing for electricity and for other alternative BTUs, because we're quite not ready for the transition that the government is forcing upon the industry.
Stephen, with a big warning. Stephen Schork there at the Schork Group. Stephen, we'll catch up before year-end, no doubt. Amazing to have this conversation about energy independence, Tom. 13.2 million barrels of oil a day produced in this country. As of the latest data out of the Department of Energy. It's amazing.
It's going to be interesting to see. Bloomberg Surveillance HR. John, let's go to it. It's important. Sheffield Wednesday. Keeping Queen's Park's Rangers out of the bottom of said league. And there's a job opening, John.
I've said to Mohammed a million times that we should put together a consortium and buy his beloved Queen's Park Rangers.
Ahmad Badia out as chairman.
He's gone.
QPR.
And Mohammed,
can we
surely.
speak here? Can we make this a job interview? What is the value of the resurgence of QPR?
Huge. They have the best grounds in London, the most intimate grounds, and the potential is great. So I'm with you guys. You go in the lead, and I'm going to follow
Ferro
you.
leading on this, let me tell you that.
If anyone out there is listening, perhaps in Saudi Arabia, that might have some money that we can
beverage at the Lanesboro on this.
Yeah,
we could have a beverage.
We'll promise
the
some
Arsenal
drinks.
guys.
We'll promise some drinks. Jay Pulowski next hour. Mohammed, I'm pleased to say, is going to stick with us through the next 60 minutes from New York. This is Bloomberg.
I can't really think of a time when there's been quite this much divergence.
Consumers are pushing back on price, and that's why prices are coming down almost across the board.
High interest costs are finally sinking in. I think we've been impatient with the long and variable lags, but they're coming and they're here.
I would be very, very concerned about a deflation scenario in the U.S. for services.
Is growth going to slow down? Yes, I think so.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Attempting to get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together for the next 60 minutes, the next hour, with the brilliant Mohammed Al-Arian. Your equity market right now, positive 0.2% on the S&P. The story this week has changed so quickly. At the start of the week, we were talking about disinflationary trends, Tom. Soft landings. End of the week, we're talking about deflation, and maybe even an economic downturn.
Even fractured markets into a fractured world. We'll talk about Dr. Larian's book in a moment, really leading in your interviews you did, John, on that in London. But, we've been doing a lot of side chat here on sports, on Formula One, on soccer. Guess what? There's some huge turmoil into the market. In November 15th, the year's over. No, it's not. This is going to be eventful to the Fed meeting.
I remember when James Athey of Aberdeen said narrative ping pong, narrative table tennis a number of months ago. Yeah. Mohammed, that's what it's felt like, just week after week, and sometimes day after day, just switching between very, very different views on the next 12 months, sparked by maybe even a small beat or small miss in economic data.
I mean, think about it, John. For the last 15 months, consensus for the biggest and most mature economy has gone from soft landing to hard landing to no landing to crash landing, back to hard landing, soft landing, and now we're talking about deflation. It's very hard to explain to people why it is that we cannot have stability in the most fundamental narrative.
Here's the book cover, the movie coming to Netflix here. We're thinking 3 years out. You'll probably see it Memorial Day 2027. The book cover is Permacrisis. John, you spoke to Gordon Brown, Mohammed Al-Arian, Michael Spence on this. And to me, the major question, John, is how in God's name did we get to where we are? And it's a loaded question besides a pandemic.
So the beauty of this book, despite the title, isn't all doom and gloom. There are some constructive recommendations, Mohammed, about how we get out of this. And it does feel like a permacrisis. How do we get out of this?
First, by understanding that there are three common causes to these crises. Low growth that's insufficiently inclusive and doesn't take into account the planet. 2 is repeated policy mistakes. And 3 is inadequate global policy coordination. All 3 can be addressed. And it is a hopeful book because we believe that we're on the verge of a productivity surge led by 3 things. Technology, and particularly generative AI, life sciences, and the climate transition. So this is going to be an exciting time if we get policies aligned and if there's more global cooperation.
But out of the pandemic, Prime Minister Brown has lived budget deficits. He's lived United Kingdom and European austerity. Now we've got the interest expense and a real rate regime that's normal. How do you handle the fiscal challenges, which many people think is a permacrisis?
There's only 4 ways to do it. Either you have growth, austerity, financial engineering, or debt rescheduling. Growth is available. Growth is the best response. The other 3 are really problematic. So we do it by focusing on economic growth.
So the headline here, Al-Arian says America's like Greece. We're going to restructure our debt like Greece.
No, Al-Arian said to you earlier that America is the most advanced in the growth transition because they've understood that you've got to evolve your growth model. Mm-hmm. And the U.S. is way ahead of Europe on this, and China is also lagging.
Are they diminished by austerity? I would love your study of austerity. It's an old world issue. Bring it in, pull it in, be conservative. Are they too austere?
Actually, nobody's austere right now, but what we've learned is you cannot shrink to growth if you've got to shrink consistently. It sounds obvious, but you'd be amazed how many countries get stuck on this austerity track.
This is going to be a big fight in the new year, particularly down in Washington, D.C. If you are just joining us, Mohammed, sitting alongside us for the rest of this hour, I'm pleased to say. Equities on the S&P 500 shaping up as follows. The scores look like this, with positive 0.2% on the S&P. Yields are a little bit lower, down 3 basis points. Earlier on this morning, a break of 440. We're back to about 440.82. Joining us now, I'm pleased to say, Jay Pawlowski, Principal and founder of TPW Advisory. Jay, in your notes, this line jumps out to me. Current conditions are almost tailor-made for a year-end rally. Jay, let's start there. Constructive. Walk us through it.
Yeah, no, John, I think we're in the early stages of a classic year-end rally. And when you think about it, all the factors are lining up. You have seasonality. So November, December, the best 2 months of the year. You have sentiment up until the past week has been very, very bearish. You have positioning where hedge funds are the largest net short position in 5 years. CTAs are offsides. Institutions are underperforming because they're owning cash. And retail sold the most stock last month of any month in the last 2 years. You add to that the technical situation where we've had a tremendous surge in the market, what are called breadth thrusts. And they are typically very, very positive. In addition, you have a number of sectors and markets and regions now recapturing their 200-day moving average. And you have some, like the semiconductor cycle, SMH, semis are breaking out to new all-time highs. So very powerful. And we know how the process goes, John, right? Hedge funds, first they cover, then they go long, then the CTAs flip. Then the institutions panic, they're underperforming, they have a gate with the calendar year end, they start to chase, and retail joins the show. So yes, very constructive between now and the end of the year.
Do we do that, Jay, with a renewed breadth, or do we do it by a continuation of focus on the Magnificent 20, say?
Well, tech is definitely the leader, and as I said, the semis are breaking out. I think this is very, very important. Because one of the debates that's going on are we late cycle about to go into a recession, or are we early cycle about to go into a new global growth cycle? I'm in the latter camp. The fact that semis are breaking out to new all-time highs is very, very constructive. So tech leads, but you have other segments like emerging markets, for example, which we are quite keen on. Emerging markets are just recaptured their 200-day moving average. You have the home builders doing well. You have, many parts of the market starting to pick up and sniff out the fact that interest rates are coming down, inflation is coming down, Fed is done, and all that is constructive for the broader swath of the market that's been laboring under the idea that rates are higher for longer.
Jay, I suspect a lot of people watching you would totally agree with your technical analysis, the handoff from one segment of the investors to another. Where they may push back is on the even more bullish call that you're going to hand off from positive technicals to positive fundamentals. So what makes you so sure that the economy will respond to the lower interest rate environment?
Well, I mean, one thing, Mohammed, as you know, what really drives stocks are earnings. And we just came through Q3. And yes, Q3 was better than expected, first year-over-year earnings growth in several quarters. But more importantly to us, because we really believe you have to focus forward in today's markets. And particularly with the narrative ping pong you guys were talking about a few minutes ago, you have to have a view, a vision, a process. And the fact that earnings for next year, 2024, in the U.S. are double digit, and they have held in even through Q3. In other words, people did not mark down 2024. That's very, very constructive. And look, we just put out our 2024 outlook several weeks ago in October called Surprise, Surprise. And we laid out 4 macro surprises, and I'll just mention 2 here. One is inflation comes down sooner than expected and faster than expected, lower than expected rather. So big drop, faster than expected. And we got a taste of that in the past week. And the second plays directly to what you folks were just talking about in terms of stability. We believe we're on the cusp of macro stability. We would point out that notwithstanding the narrative ping pong, the VIX is under 15. The MOVE index for treasuries is under 20. So there's a lot going on that we think is very positive, and that the market is starting to sniff out. And that makes us constructive, not only through year end, but into 2024.
Jay, typically when you're constructive, you're thinking about the rest of the world. Am I hearing tech in the United States right now?
Yeah, John. I've converted. We did add directly to U.S. tech in our latest model portfolio updates that we did a couple weeks ago. We have been long semis for pretty much the whole year. So that space has been one we've participated in and have benefited in. So yes, we are believers that big tech, the idea was that higher rates would hurt big tech because of the way people value long-term cash flows. The reality of today is that big cap tech are money-making machines, and they are printing money on top of the money they've already printed in terms of interest rates being at this level. So tech is a leader, and I think can sustain that leadership. But the rest of the world also offers a lot of opportunity because they have valuation and earnings growth. U.S. is capped by its valuation. It's going to be earnings driven. The rest of the world, valuation and earnings growth. So we really continue to favor the rest of the world, particularly, as I said, emerging markets.
John, what you just heard there from Mr. Pulaski, I'm going to suggest is a minority opinion. Into this weekend, coming into the end of the year, the holiday season, people can't fathom that tech will extend.
They can be constructive going into year end, but constructive for the whole of next year, I think, is a very different call.
Major outlook analysis.
Jay, before you go, I know you wanted to squeeze in a question for TK. What is it?
Yes, indeed. Tom, our two schools are going to meet on the field of football battle tomorrow. And as a Duke guy, I always have wondered about this. And so you're a perfect guy to ask. What the heck is a Wahoo?
The Wahoo, well, you know, I look at the Wahoo and I say, I got to talk to Shonali Bassick, because Shonali Bassick is the Bucknell wonder. I mean, she's encyclopedic on this. And, you know,
She's a Bucknell grad.
She's a Bucknell grad.
That's a school in Pennsylvania, right?
This is, I think, it's football or basketball. I'm really not sure which, but the Bucknell Bisons taking on the Duke Blue Devils, padding the schedule, Pulaski.
Where do these names come from? Where do these names come from?
It's tradition, John. This is, Mohammed, this is something really difficult. The whole college football thing, the college sports thing, to John, we might as well be in the Pacific Rim.
College football to me is Alabama, LSU,
They're
Georgia.
professional combines.
Like that's what it is to me.
I'm worried about Cambridge cricket. You know,
that's a real sport,
that's
isn't
a
it?
real sport.
That's a very relaxing thing, you know.
Yeah.
I can play cricket
I
in the
haven't
summer.
figured it out yet.
Can have a couple of beers watching that, TK. Sit there all day, chill out. Very relaxing.
Beer at a cricket game?
Yeah, in the stands.
Yeah,
Not when you're playing,
It's a British thing,
Not when you're playing, Mohammed. Jay, thank you, buddy. Jay Pulaski there of TPW Advisory. If you are just joining us, equities right now positive by 0.2%. Yields are a little bit lower by 3 basis points. Tom, 440.63 on a 10-year.
Well, the 10 years, the thermometer here, it is the benchmark yield. Mohammed Alarian, which maturity should our audience focus on? The benchmark? Or do you go to 2? Or do you go out to 30? Or my 97-year Austrian?
It depends for what, John. And they should also focus on the shape of
John.
the... Sorry.
I'm Tom.
It's been a long
He's
hour.
new. Come on, let's
minutes.
go. Chart banner.
Mohammed hasn't had to do the PIMCO alarm for a long, long time.
That's true.
The best part of a decade. Setting that alarm to like 3 a.m. to come on this show.
Yeah,
you forget who people are, Tom.
Yeah,
and then waking up 10 times beforehand because you're worried you're not going to get up at 3 a.m.
And miss the alarm.
And miss
the sleep, that's sleep anxiety. You know, I never wake up to my alarm, ever. Always wake up before it. Always. By about 30, 40 minutes.
And you get up?
No, I just sort of lie there, roll around and start reading the news. And often Tom will message me like at 1, 2 a.m.
Telegraph comes out. What's Ambrose Evans Pritchard doing?
Literally 1, 2 a.m. just get these texts lighting up the phone about.
But and what's great about
nonsense.
this, Mohammed, in the world, the orbit that we're in, people think Ferro works a 4-hour day. They think I extended. I work a 4.5-hour day.
And how wrong? They are very wrong. Right?
Well, a little
Thanks
bit
for your support, Mohammed. We appreciate that. Mohammed's sticking around, I'm pleased to say. David Lefkowitz of UBS Global Wealth Management joining us in the next hour. Equity futures on the S&P positive by 0.2%. Live from New York City this beautiful Friday morning. Good morning.
We gather this week in San Francisco at an inflection point in history. Together, we can harness the power of the Pacific to grow our economies, to uplift our workers, to protect our planet, to connect our people to one another. So much of history of the world will be written in the Asian Pacific in the coming years. We must never forget that it's a history that belongs to all of us.
It's been quite a love fest in the last 48 hours in California. President Biden hosting an APEC dinner, capping off 2 days of meetings with China's Xi Jinping and other foreign delegations. The president leaving San Francisco today to spend time in Delaware over the weekend. Some of the language that came from President Xi, pledging to take heartwarming steps to attract foreign capital, develop a world-class business environment. We mentioned at the start of this week it was likely we would get this charm offensive from the leader of China, Tom. That's exactly what we've had this week for sure.
Watch where people sit at a gathering to the right of the president as he made those comments. Folks on TV, a standard standing at president and the worthy seated was Mr. Lee of Singapore after his interview with our John Micklethwaite at the New Economy Forum. And again, this is about China and the U.S., but in a broad sense, the Pacific Rim as well. Our military, our treaty obligations, the approach of Washington to a Pacific Rim of a new century.
They are all with a big interest in this, Tom. I would say there are two countries that I can think of just straight off the bat that have benefited from this tension between the United States and China. Vietnam being one.
Absolutely.
And I think Singapore, given what's happened with Hong Kong over the last few years.
Yes, absolutely.
Singapore, I think if you wanted to put a headquarters now in Asia, Tom, and you were really thinking about doing it 20 years ago, 10, 15 years ago, most people in finance would say Hong Kong.
Absolutely.
Now I think they'd be saying Singapore.
Even with a long plane flight down. And what's really important is Abramowicz is picking up Alarian, who really, really wants to jump in here. Mohammed, on the Pacific Rim, and to see Mr. Lee sitting to the right of the President of the United States.
So what I think we have to understand is that most countries have what I call a dual option approach. They rely on the US for national security and they rely on China for economic prosperity. So the last thing they want is to make a choice. So they are very happy to see a rapprochement between the US and China. But we also have to remember that rapprochement was in the interest of both leaders. Both leaders needed to be seen domestically as doing something that is consistent with their leadership. Xi needed it desperately. So I'm encouraged by what we saw, but I wouldn't get carried away.
Can I name a fence sitter trying to play both sides and have done for a while? Germany. Germany happy with this?
Yes, I think Germany is happy with this. John, no one wants to make that choice between aligning either with China or the US unless they're really forced to. Australia has discovered the cost of not getting it right.
A lot of happy talk this week. Jeanette Lowe-Strategas weighing in on this meeting between Biden and Xi and saying this: the meeting does not change the trajectory of US-Chinese relations. Tom, the US will continue to push for de-risking or decoupling with China in order to protect its national security interests, and China will continue to push to develop a multipolar world against US interests. Jeanette Lowe there.
Join us now from Strategas, Ms. Lowe. Jeanette, I look at where we are, and of course, the major question is, what's the next step? What is the next step? Should we look for President Biden to visit China?
You know, that's probably to somewhat extent unlikely. I think maybe if we look back at last year, we had a meeting between Biden and Xi in November of 2022, and, you know, not much occurred out of that. After that, a couple months later, we had that spy balloon flying over Montana, which then ruptured relations again. So I don't necessarily think that there's going to be a lot more steps moving forward. It was also very interesting to have the defense secretary at the exact same time in the Philippines talking about continued coordination while this APEC and the Biden-Xi summit was happening in San Francisco. So I think this is going to be about trying to lower the temperature, trying to make sure we have continued communications. As you guys have mentioned, having Xi, he wanted to he's having some domestic issues. This is also a good opportunity for him to kind of have a reset. But ultimately, I think that the two sides are going to continue on their trajectories, and this is not going to change the overall path. What it is going to do is just make things a little bit easier in the short term. We have an election coming up in the U.S. We don't want to continue tensions with China. But at the same time, if Biden was to be too conciliatory towards China, we have a whole lot of hawks in Congress who would then pounce him on that.
So, Jeanette, I very much agree with your analysis. Can you take it one step further? How easy is it to de-risk without decoupling?
Right. And I think that this is part of the issue, too. I mean, you have the U.S. has been trying to make strides to de-risk from China, but it's going to take quite a bit of time. Obviously, we're quite reliant on China for supply chains, for critical minerals, for a whole host of things. And so it's going to be very difficult to actually move those pieces away. And so I think that trend is in place, and you're going to see it continue over the next couple of years. But that also means that to some extent, you almost need a détente at the highest level so that you can build these pieces out from the bottom and ultimately get to that de-risking. I don't think decoupling is probably where the ultimate goal is, but it is really about trying to protect U.S. national security interests and making sure there is reduced dependency on China. And I do think that you are seeing that, you know, regardless of the fact that you have to make choices between how you align with the U.S. and China, there is an effort, or there is a realization across the globe that having too much dependency on China is not a good thing either.
And from China's perspective, de-risking involves building little pipes around the U.S. at the core of the system. How far can they go into building basically an alternative global system?
So this is obviously something that they have been working on, and they would like to continue to accelerate that. I think the one thing that is important is I think the fact that the U.S. is not doing this alone is important, that they will actually be more successful in actually trying to at least move supply chains. China's still going to be involved. China's still going to try to, work with their partners in Asia to get around some of those pieces. But the other thing is that if you look at China trying to build this multipolar world, they have been doing that over the course of a couple of years. They're trying to obviously move away from the US dollar. They're trying to get other countries to do the same. But if you are looking at China also being in a place of having economic weakness, that also is not necessarily conducive to them actually being the leader of that movement. So there's a lot of things that have to be worked out on both sides to actually reach their ultimate goal. And I think that's why we're going to kind of see I don't want to use the term muddle through, but kind of a muddle through scenario where they continue down their path. But there is obviously some need to be conciliatory in the interim.
Quickly here, Jeanette, and I've been guilty of this all week. I have failed and taken my eye off Ukraine. Ukraine in this cold December. What will that debate, that study look like?
Right. So this is the U.S. does not have a lot of military aid left to provide to Ukraine at the moment unless Congress appropriates more funding. And so the spring offensive has not necessarily produced the results that both sides were looking for. We're going into the winter, which makes it more difficult for there to be progress on the battlefield. I think that you will see an effort in Congress to try to come back from a Thanksgiving holiday and pass Biden's national security supplemental, which would provide aid for Ukraine, as well as Israel and Taiwan and the border. But that is something that they still are trying to find a solution on. They need to figure out whether or not they can add border policy changes in order to get Republican support for that bill. But if we don't get aid to Ukraine over the next couple of weeks, there is probably going to be a strong hole put into Ukraine's defenses, because they really do need more money. You obviously have Europe also supporting them, but Europe has been struggling to get some aid packages passed, some munitions given to them as well. So it's been put on the back burner, but I think you might start to see more discussion over it over the next month in Congress at least.
This is the fight we're going to see going into the new year. Jeanette Lowe, a strategist. Jeanette, thank you. Just to go back to China, Mohammed, we talked about the nation states that were sitting on the fence, trying to maintain a relationship in both spheres, China and the US. Can we talk about corporate America, which is trying to take this pragmatic approach, but on the surface often contradictory, please progressive consumer bases, maybe in the United States, but at the same time appease foreign dictatorships? How's that going to go? What do they do?
So it's easier for a country to be a politically swing state, as Jared Cohen of Goldman called it, than for a corporation. If I was sitting in a board right now, I would caution against investing too much into China.
And that's what we've seen over the last year, Tom, which is why you see it in the data. Foreign direct investment.
Oh, no question about it. The data point of the last 6 weeks.
You don't turn that round with some happy talk in San Francisco, California. Maybe that's a start, but it's not the end. This is Bloomberg. So far, so good in this market. Equities up by 0.2% off the back of 3 days of gains, poised for a third week of gains on the S&P. Longest weekly run since the summer, I believe, going back to July. On the Nasdaq, we're just about positive 0.04%, and the small caps on a Russell absolutely everywhere. I had a note from Torsten Slock just moments ago. Let me pull up the email. On the Russell 2000, before even entering a recession, this is what he had to say, Tom. The share of companies in the Russell 2000 with no earnings is at 40%. 40%. That from Torsten Slock over at Apollo just moments ago.
Really important on profitability. It drives me nuts. And I say this about Apple with all the doom and gloom. I'm dressed like Dan Ives today, so I was going to be careful here. Do you run a company for growth at the top line, or do you run a company for growth down the income statement? And that's a parsing that financial media doesn't do enough.
It's difficult going into next year, that's for sure. They're the numbers right now, and we get an economic downturn. What do the numbers look like in 12 months' time?
I think by the middle of January, third week of January, I'm going to be able to announce on the show that my theme for 2024 is the sustaining of the Magnificent Seven. I don't have some cute phrase yet, but I think that's really where we're heading.
Saw the same thing over at Goldman.
Redo.
Let's turn to the bond market.
I'll steal it from
2 year,
Goldman.
10 year, 30 year. 10 year right now. Yields lower in a big way from where we were last month. We've gone from 5% to a break of 440 to just above 440 right now. 440.63 on a 10 year. Down about 2 or 3 basis points. Tons of feedback this morning about our consortium that we're putting together to buy Mohammed's Queen Park Rangers. As they just discussed, I'd happily support the idea of the three of us putting together a consortium to take over at Loftus Road.
And what's great is out of Thanksgiving, we can wrap it around, Saturday, November 25th. Is it Norwich or Norwich? Norwich. Norwich is like where the Pilgrims came from, East Anglia and all that, right? And so they're playing QPR at Norwich, and we can go and feel the Pilgrim experience.
Mohammed can get us some tickets. Andrew Ball's over at PIMCO. Norwich is his side.
Yeah, and he goes to every game.
Ed Balls used to run the club, right?
Correct. He used to be chairman.
Used to be chairman.
Yeah, there you go. So
keep it
we
in the family.
Can go there and we start a rumor. Henry Winter will pick it up, and
Let's turn to foreign exchange. Checking on the euro. Eurozone inflation final read for October came out. Had a two handle. Came out a little bit earlier. 108.65. We're positive there. 0.1%. Let's get you some company stories under surveillance this morning. Disney CEO Bob Iger planning to address employees in a company-wide town hall after Thanksgiving. A number of senior executives, including the heads of film, TV and park divisions, are expected to join the discussion. The media giant has been battling activist investors and struggling to adapt to changes in consumer viewing habits as consumers cut the cable cord, Tom, in favour of streaming. It's messy over at Disney, Tom. It feels like things are for sale. ABC, ESPN. I think we all want some clarity on the path forward from here. Jeffrey
Ubben out of Duke, and you're really quite good and skilled at value act. And the answer is he's not going to yell and scream, get up on the table and do this. It's going to be a governance mission by these activist shareholders that are stirring the pot and trying to get them forward. What I would suggest is they're getting them forward in a technology that hasn't identified profit yet, with the exception of Netflix.
Should we discuss activist unions? United Auto Workers,
employees
at GM approving a new 4.5-year labour contract, ending a tumultuous months-long bargaining process by a slim margin of votes. The historic deal will see base wages increase 25% over the life of the contract, the return of cost of living adjustments and the ability to strike over plant closures. Voting is still underway at Ford and Chrysler parent Stellantis, where workers reportedly support the agreements by wider margins than over at General Motors. Mohammed, let's sit on this for a moment. 25%. You and I have been talking about this now for weeks, if not the last few months. Do you look at this situation as the dying embers of a hot labour market, or is this a sign, a forward look as to what might be in store for us around the corner?
I think it's the latter, John. I think we are finally seeing labour getting more power relative to capital, and that reverses decades of capital totally dominating. So yes, I think this is an important shift. It does reflect the structure of the labor market, and I suspect you'll see other agreements follow this one.
The labor share here, can the wage gains on a real basis move outside the union debate over into a largely non-union America?
I think they already are doing that, John. We see
Honda, we saw 9%. See, he called me John again. See how he does that? No, it's like we're going for the hat trick.
He's never going to come back.
He's never going to come back.
Never going to come back.
Bill, continue.
I am speechless. I would love to be called John. Are you kidding? It would be the biggest compliment.
It is.
You can call me
compliment.
John anytime you want.
Thank you so much. What a compliment.
On the non-union America, Honda will lift wages 9%, I believe, off the UAW.
I've never seen you blush before, Tom.
It's a makeup. You know.
Let's turn to another story, TK. It's okay.
Save us.
IBM. This is a serious story. Announcing the company is suspending its advertising on X, the platform formerly called Twitter, after their ads were spotted by a watchdog group next to pro-Nazi post on the site. It comes a day after Elon Musk endorsed an anti-Semitic post on the service targeting the Anti-Defamation League. The incident prompting outrage from an investor over at Tesla, with the electric car company stock falling by almost 4%. Tom, where to begin with this?
Where to begin with this is a really delicate question with immense respect to the career of Mohammed Al-Arian, who has done well and prospered in business. Do people start thinking differently when they have a lot of money? I mean, Musk here has a ton of money. Like, is he richest guy in the world?
One of.
Something like that?
Sure.
And the question is, do they think differently than we do?
I think they believe that they can control any narrative, and they are surrounded normally by people who simply reinforce that.
On a second-by-second basis.
Yeah.
By a phone call
Tom,
basis.
you've got the business damage that it could do to X. IBM certainly taking a step back. We'll see if others follow. And then you've also got the brand damage you do to Tesla simultaneously at the same time. Never mind the investors. What about being associated with that brand, given that you know that brand is so closely associated with Elon Musk? Those kind of comments, I don't even know where to begin. I don't even know what that's about.
Linda, the chief executive officer here, how does she respond to this professionally and personally as well?
Do you get the feeling that Linda Yaccarino is running that company?
I don't think anybody's running Elon Musk but Elon Musk. I don't think I'm editorializing
I'm
there.
right there with you.
Yeah.
I think a lot of people feel the same way.
I just think it's fascinating, and it speaks to Davos and all that we're going to see there. And the basic idea is the fancy, great, and worthy. They're not running around making Elon Musk comments.
I say this every year we go, Tom. Davos needs to get real.
Yeah.
This establishment nonsense, everyone on the same page.
Everyone on the same page, I think, is
they need
is
some
fair,
real.
they need a real debate.
They talk about diversity there all the time. They need some real diversity of thought at that conference. Which
so if we go and do an hour,
we
can do an hour there in Formula One racing. It'll be huge. I mean, think of the Toto would show up from Austria.
Hey, Toto is just a business guy. You see his reaction to the mess in Las Vegas.
But he's also an academic. I mean, this guy from Mercedes, Mohammed Al-Arian, lectures at Harvard, lectures at fancy schools like Cambridge. I mean, he has a real care about the academics.
He does. He really does.
We'll have to see. Right now, joining us, and I'll decide. Chief Investment Officer, Fixed Income at Franklin Templeton. She has survived 2023. Chanel, are you going to clip the coupon like Bill Gross did at the bottom of PIMCO years ago, or can you find total return in fixed income next year?
I think next year is going to be more clipping the coupon. You're getting the income because I don't buy the rate cuts that the market is pricing in. Right now, the markets are priced, I would say, for beyond a perfect landing, right?
Given that, then, what's your call on the bond market now, Chanel? We've had this big correction from 5 down to 450, down to 440, briefly 430s this morning. What's the call now?
It's been too fast. I don't think it's underpinned by fundamentals, and I do think we're probably going to get a reversal. So I think that closer to 5 is a lot closer to where the bond market needs to be. Does it happen in the next week, 2 weeks, or even this year as we rally into year end? Maybe not. But the reality is, if the Fed talked about financial conditions and then unsurprisingly has stopped, because at every level, including what we're hearing in terms of wage agreements at every level, I think there do remain risks to inflation. And while I think the Fed will certainly there's a lot of data supporting the Fed remaining on hold, there isn't enough data supporting the pace of rate cuts next year that the market is pricing in right now. So that's the part which I think is unlikely to materialize.
So now let's get your view on flows, please. A lot of people are waiting for the extension trade. People going from the front end to locking in higher yields for longer. Have yields moved down too quickly for that extension trade, or is the move down actually accelerating the extension trade?
So, I think that right now we continue to see, Mohammed, I think that the speed has been too much. So I still think that there's serious risk to the trade. I don't think this is the real extension trade yet, because there remains a lot of money at the sidelines. So I think it was too fast. And I think that we will see more volatility when you see something like 50, 60 basis points coming as quickly as we have seen it come. It smacks much more of fear of missing out, because it's happening at the same time that we're seeing, for example, high yield rally all the way down to 375. We're seeing yesterday it was a 30% chance of rate cuts beginning already in March. If you need that kind of a narrative to support these types of rates, I don't think that's realistic. So as those rate cuts again start getting priced out, I would expect 10-year yields to start moving up as well. And there is the last piece on flows, which is the fiscal deficit, the fact that over the next 3 months, 6 months, at some stage, Japan starts moving, and we're going to see additional support leave the long end of the yield curve. So there are just many reasons not to fear that this is the beginning of that serious rally.
Okay, and when you said this is beyond, well beyond a soft landing, I think was your phrase.
Yeah.
Tell us a little bit, what's the catalyst for changing the dynamics the way you think they will change? What are you waiting for? What would be the catalyst?
Catalyst for not having a soft landing or having a soft landing?
No, for seeing, in your words, reality get back into the bond market.
Right. I think actually the data, in part the data, the Fed has tried to do what it can do in terms of saying that no, rate hikes are not off the table. Certainly the SEPs might play a role, but it's not clear that they're going to actually continue to call for no rate cuts. But the quantity of rate cuts which the market is pricing, I think those start getting priced out. And I genuinely don't think that we're seeing yet. We got a good data point. We did not get a sustained reduction in inflation. We got the move from 9.5 to 4, absolutely. The move from 4 to 2, I don't think comes as quickly and as smoothly as the market is anticipating, particularly in light of some of these wage increases we're seeing and the fact that fiscal policy actually remains quite expansionary. On a cash basis, most of the Inflation Reduction Act's deployment hasn't even happened. So we're going to continue to see support from that going into next year.
So now, appreciate the update. So note is either a Franklin Templeton on this bond market, maybe getting a little bit too happy with itself about the prospects of a soft landing. If you are just joining us, equities look like this. Firmer, positive by 0.3%. Yields a little bit lower by 3 basis points, 440. The turnaround's been amazing. I want to go back to something we talked about a little bit earlier, guys. We've been conditioned by having big shocks and seeing how the Fed responds to big shocks. I think what's forgotten is some of those surgical cuts that took place back in 2019. Mohammed, this Fed is capable of moving 25, 50, 75 basis points under Chair Powell without going all the way back down to 1%, 2% from where we are.
But go back to Mary Daly's FT piece that we talked about earlier today. They are really worried of repeating the mistake of the 70s. They do not want this stop-go process. So I think the hurdle for rate cuts is much higher than what the market thinks it is.
Given the communication we've had then, to put you on the spot, forgive me, the biggest risk right now, is it that they don't go far enough or they go too far? Is it they go too far and stay like this too long?
I think that's the biggest risk right now.
That's what it feels like, Tom, going
into
2024.
I talked to Claret about this at length. He and Gertler inventing the mathematics of all this optionality. Is there an operative theory right now in their new measured approach?
No, if there was, then they wouldn't repeat data dependency, data dependency, data dependency. This is a Fed with very little strategic vision, unfortunately.
Just hold that thought. We're going to talk about that in the next segment. Final segment with Mohammed Al-Arian here in New York City. This was fun, Mohammed. Stick around. We'll do another 5 minutes or so. Equity futures on the S&P positive from New York. This is Bloomberg.
I think what's more likely is a kind of rocky landing where inflation stays stuck at 3, rates stay high, there's some slowdown, and it's a kind of malaise. It's a single-digit equity environment with a real risk that something breaks and you get into a classic recession. So it's really between that rocky landing and then a kind of a classic recession break that we think is most likely to happen.
That's a new one. Rocky landing, classic recession. Just the range of things over at Federated. Steve Cheverone, the brilliant Steve Cheverone, a little bit earlier on today. Some final thoughts with Mohammed coming right up. Let me get you a thought from Citi this morning, just publishing. Andrew Hollenhorst. Here's the quote. From now until the end of the year, we do not project any data that will disrupt the risk-on Goldilocks narrative, but the reality is less pleasant. Andrew and the team going on to say, rising initial and continuing jobless claims may be an early sign that activity is slowing. They finish with this, Tom, and underlying inflation stuck above 3 will constrain the Fed from acting preemptively to avoid a growth slowdown. That's how they're thinking about 2024.
We're going to dive into this conversation. This is so important with Mohammed Al-Arian of the University of Cambridge and writing so much to help us with our clear thinking on these matters. John, as you mentioned, the next strategic theory and what it looks like. And I would suggest the analogs that we have of the past are hugely faulted, including the analog of Jerome Powell in comparison to Paul Volcker in that time. How do we get rid of our ancient analogs to get to our next strategic theory?
So I think, Tom, the one thing we need to do more of, especially among policymakers, is listen to the corporate earning calls. The reason why they missed the inflation call and got stuck on this notion that it would go away very quickly is because they weren't listening to company after company saying that their costs are going up and they believe they can pass it on because demand is strong. Today, most companies are telling you demand is softening really quickly. We've heard this both at the high end and at the low end, which is really unusual. So you've got to go be more forward-looking and stop relying on dated numbers.
Right.
This excessive data dependency is going to get us into another problem.
The great Stephanie Kelton will join us later today, folks. This is so important on the linkage of policy and fiscal into monetary. Have we conflated our monetary and fiscal policy? Alan Greenspan fought that day after day. Is Jerome Powell prosecuting fiscal theory?
No, I don't think so. I think during the era of QE, where the Fed was pursuing QE for a different reason, they enabled larger and larger deficits, and they enabled excessive risk-taking. They enabled all sorts of things, but they didn't want to do that. That was just an unpleasant consequence of something they had to do. So I don't think so. I don't buy this fiscal dominance argument, but I do think that if you look at the fiscal side, you can have a situation where yields stay higher and inflation stays higher despite the fact that the economy is weakening faster than people anticipate.
You've been very critical of this Federal Reserve and the leadership of it. You mentioned just before the commercial break the lack of a strategic theory. You've written about this as well, Mohammed. For those that haven't read those pieces, what do you mean by that? What would you expect to see? How would this Federal Reserve change in the leadership of it in the coming months if they developed a strategic theory?
So look what happened in the last month. Chair Powell came out and said something really encouraging. He said, we are seeing more supply coming into the economy. The market loved that. Why? Because that's the solution to a lot of our problems. If we can enhance the supply side, you get more growth, you reduce inflation. Then the very next speech, he steps away from that. The very next speech, which confuses people. So are we looking at a world in which the supply side is getting more flexible? Are we not looking at a world where the supply side gets more flexible? The Fed has to be more consistent about how it believes the economy is going to evolve. You know, that is what central bankers do. That is what Greenspan did. That is what Bernanke did. That is what Yellen did. They didn't just repeat over and over again, we are data dependent.
They were consistent, though. They were consistently wrong coming out of the pandemic. And arguably they had a strategic theory, but it was the wrong one. Or at least it took a lot longer to play out than they thought it would. Haven't they been burnt by that? And isn't that why they've become so excessively data dependent because of what happened coming out of the pandemic?
It may be. It may be. I can't get into their heads. It may well be that that's the case. But when you're wrong, the answer is step back and try to figure out. We've had failures of communication, analysis, action, supervision, and accountability.
I mean, I look, Mohammed, and I go to Alan Meltzer on this. I've mentioned this many times before, and he would chastise me and say, you have to aggregate statistics. That's what we did in 1947, Leontief and all that. Can we have an aggregate strategic vision now for a Fed, or do we have John Edwards' 2 Americas or 3 Americas where we can't have an aggregate economic vision?
Well, their mandate is such that they have to have an aggregate view.
Yes.
When it comes to distribution issues, which are really important, really important, the amount of inequality in the U.S. today is excessive. That's the fiscal side. So the Fed can have a view, and it needs to be an aggregate view.
I mean, I look at Branko Milanovic with his wonderful book out now on inequality, and the heart of the matter is the inequality that Jerome Powell has to prosecute is just extraordinary. I mean, there's no other way to put it.
And we don't talk about it enough. It's not just a social and political issue. It's also an economic and financial issue.
How do the haves get the trust back of the have-nots?
I think by showing that they care more about inequality. You cannot be a consistently good house in a weakening neighborhood. You've got to take into account the neighborhood. Equality really matters.
Trust is just shattered of the establishment. To reframe your question, Tom, what you're really asking is, how can the people trust the establishment, given what happened with the pandemic, coming out of the pandemic? And Mohammed, we do have an administration that claims they care about all of these things, yet you go through some of the polling, the trust isn't there. The trust in their ability to deliver just isn't there.
And you know, when you look back, we're going to look at this administration as having delivered an amazing number of jobs, at having helped pivot the economy to a new growth model. But it's being judged on inflation. And inflation is really problematic. You know, John, when we all talk about inflation coming down, the public believes that inflation coming down means prices coming down. They don't understand that inflation coming down means that prices are going up at a slower rate. And why they don't understand that? Because they're getting poorer. So the irony is that the Fed's slippages on inflation has significantly undermined the trust that the people have in the administration, even though the administration has largely delivered on what it said it would do.
Don't you think we need to change how we talk about the economy, though? Because the electorate feels what is real, which is ultimately prices in many cases are higher than they were pre-pandemic versus now. And we talk about this month-over-month stuff, this year-over-year stuff, and it doesn't resonate for obvious reasons, because for a lot of people, that's not how it works. When we sit here and we strip out food and energy, I think a lot of people sit at home, Mohammed, and say, well, hang on a second, where am I going to live? How am I going to fuel my home? How am I going to feed myself? These things don't make sense.
Yeah, so a few days ago, I tweeted, we don't say tweeted anymore, I don't know what we say.
We post.
I put on my social media platforms a graph from the Wall Street Journal that showed the absolute level of prices of certain things, food, gasoline, and housing. And just look at that. And that's the reality.
That's Brainer's cumulative, though. Our audience, radio and TV, is thinking cumulative inflation, and the bow ties are going month over month, year over year.
That's what they live in. Mohammed, can I just say this was great?
Well, thank you for having me.
Privilege, a pleasure. No, thank you, sir. Thanks for being with us. 2 hours gone just like that.
Jets,
just like
next
that.
3 weeks.
No, I was just about to thank you for not mentioning the Jets.
Jets, tough schedule. Bills.
Very tough. Very. But the fact that we're 4-5 and the fact that the Patriots are 2-8 is the only thing we should care about.
You're far too modest to do this. I remember Mohammed at the start of the season did not want this Rodgers trade at all. Didn't want it. Jets all got happy about it. Then what happened? He's going to come back, isn't he? Is he going to make it back before the end of the season?
I think he's trying, but most people are telling him don't rush it.
That's amazing.
You know, this just popped into my puny head. I mean, if the Hess family, Amarada Hess, Jets, Green, get it. If the Hess family sells out to Chevron, is this another you could be like some Premier League titan. Mohammed could have QPR and the Jets.
I know for a fact that Woody Johnson watches this program, so maybe Woody can help us.
The Ambassador Johnson.
QPR, forgive me, Ambassador Johnson watches this program. So,
and
Woody,
Ambassador Johnson really cares about the Jets, I can tell you.
Can we get him to care about QPR?
I didn't have time today. We'll do it another time. I want to talk to you about Egypt, which in Robert Kaplan's The Loom of Time is the pivot point of
I look forward to that.
Mediterranean.
And thank you for having me.
Hey, Mohammed, thank you, sir. Appreciate it. Really do. Coming up on the program, we'll catch up with David Lefkowitz of UBS Global Wealth Management on the equity market. Equity's doing nicely this week, heading towards a third week of gains on the S&P 500, following a third day of gains in Thursday's session. Equity futures up by 0.25%. Live from New York this morning. Good morning.
The Fed's done raising rates. I believe that part of the process is complete.
We've been trying to figure out, is the Fed really done? I think that the market's now drawn that conclusion.
This is the kind of softness in the labor market that we have needed. And of course, it takes pressure off the Fed to raise rates again.
In that world in which the Fed is very hesitant to declare victory over inflation, it's hard to imagine rate cuts are forthcoming.
I think the Fed is going to be patient here, but I don't think this is a victory.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Bramo refrigerator shopping on a Friday out front of the Black Friday sales. We're looking at equities they lift, but it's in the yield space where John and I are focused this morning. Moments ago, John, the 10-year real yield breaks down to new weakness, 2.11%. Can you imagine a 1.99% inflation-adjusted yield?
TK, the turnaround of this bond market's been amazing. You're talking about real yields. Let's just go to nominal yields through 5% higher yields in the last month, then lower, much lower yields in the last month. TK, break of 440 this morning. This morning, right now, 441.60. Citi's Andrew Hollenhorst. I think we have to keep going back to this. Let's return to this quote, Tom. We do not project any data that will disrupt the risk-on Goldilocks narrative, at least until the end of the year. Andrew and the team going on to say, but the reality is less pleasant. Initial claims, continuing claims, may be an early sign that activity is slowing. And he goes on to say, and this is really the important line, Tom, underlying inflation stuck above 3% will constrain the Fed from acting preemptively to avoid a growth slowdown. That right there, I think, is the counterpoint to the happy talk around the soft landing, disinflationary story of the week so far.
Okay, I get the assumption of a growth slowdown, and that we will see in the coming data, including up to the December Fed meeting. Look for the Fed decides at that time. But, John, what I find important here is, for example, on this weekend of perfect home viewing, leaves falling, the dappled autumnal leaves of New England, and on down. Think what Central Park looks like from that
Beautiful.
view.
You and I can take a stroll this weekend.
8.03% down to 7.69% on the 30-year bank rate. If we get the presumed disinflation, what do you do with a $699 mortgage? You say, let's go.
We caught up
That's
with
what Hollenhorst is talking
earlier
about.
this week. He was talking about grease in the wheels. Grease in the wheels. This is why the Fed, Tom. Let's be clear about this. This market, many people in it, a lot of equity bulls that you listen to on this program, they want to declare victory over inflation. It's why the Federal Reserve doesn't want to go there.
Exactly.
Fed officials do not want to prematurely declare victory over inflation. Can you imagine what would happen to markets if they did? Chairman Powell schedules a speech tomorrow. Comes out on a Saturday morning.
He's got to be ex post.
Comes out and says, you know what, it's done. We're done. It's great. We can start cutting rates from here. What do you think happens Monday?
Well, yeah, we saw that this week with the CPI report in 1 minute. John, that described that best, the 11 ratio, Bloomberg Financial Conditions Index, and it screams accommodative. It's 0.26. That's exactly what Chairman Powell doesn't want. But you know what he needs? He needs a data check.
A data check. You want one right now?
I think we should do one right now. Euro yen is, better.
On the S&P, I'll keep it vanilla, Tom. You can go to Euro yen in just a moment. Equities at the moment are positive by 0.26%. I've talked a lot about this 3-day winning streak. Could be 3 weeks of gains on the S&P. Up a little more than 2% over the last 3 days. About that on the week at the moment as well. 3 weeks of gains, the longest weekly streak potentially, going back to July. Looking at the bond market, I mentioned where yields are. We're down 2 basis points on a 10-year, 441.60. We've got to talk about crude. Entering bear market territory and all of that bad stuff, Tom. Look, down 20% from where we were in September. TK, I was looking at crude earlier this morning, just like you were. We're down about 8-9% on the month this month. We were down close to 11% last month. We had a conversation at the start of October. Remember London? Went to London together. We had all the bulls talking about triple-digit crude by Halloween. And Rita Sen of Energy Aspects.
Right.
here we are talking about the 70s and maybe even a break of them.
And what it does to gasoline, which for President Biden and all, even the Republicans, is a very emotional topic. John, totally obscure here on a Friday. We like obscure on a Friday. And we do this because Italy taking on Northern Macedonia here in a fun fest. The Italy-German spread is really showing some quiescence, where if you break down to a constructive spread for Italy, that's again that same idea of a good feeling.
They need that right now because there are some questions about Giorgia Meloni's plans for the deficit over the next couple of years, and maybe even a dispute on the horizon with the European Commission. And Tom, I think we all hope we don't have to play that game again on the periphery, particularly in Italy.
Futures up 13. The VIX under 14, 13.88. David Lefkowitz knows this. Head of U.S. Equities, UBS Global Wealth Management, joins us today. I got a 72-page UBS phone book yesterday with scenarios linking GDP into yield into Standard & Poor's 500. Which scenario do you believe in without upsetting Mark Halfley?
That's an easy question. Our base case, Tom, is that we're going to see moderate gains in the equity market in the coming 12 months. You're referring to the year ahead publication that we just put out. And we're also going to see some nice gains in the bond market with yields falling. So, our main message is that we think there's a good chance that we can have a soft landing. That's really the core of our base case thesis. Economic growth in the U.S. likely will slow down. We know the student loan repayments have restarted. Excess savings is becoming less pronounced, and but we think the soft landing makes sense.
This is so important because I'm trying to buy my first share this weekend off the triple leveraged all cash. If I look at factor analysis, which of those factors will benefit next year? International versus U.S., value versus growth, and the other 14 factors, which matters to you?
So our factor that we like the most, really across stocks and bonds, is quality. So we're in a late cycle environment. Right, we have a low unemployment rate, we have an inverted yield curve, and inflation is coming down, but it's still higher than the Fed's target. That's a late cycle environment. For stocks, in our work, that suggests you want to own quality companies. These are companies that have high returns on capital, they have strong balance sheets, they generate consistent and generally less volatile earnings growth. And I think that's the same is true in the bond market. Right, you can go out into investment grade corporates, get a pretty nice absolute return. There's other parts of the bond market that also look pretty interesting. We actually here in the U.S. we actually like high yield against senior loans. So I think there's a whole host of opportunities, but we would clearly focus on quality across the spectrum.
David, can we get your rate cut call? What are you and the team looking for next year?
So we think the Fed is going to be slower in terms of cutting rates than what the market is pricing in. We're penciling in 2, maybe 3. But I think this Fed, especially with the unemployment rate as low as it is, I think this Fed is going to be fairly cautious in terms of getting too aggressive. And just to what you were talking about earlier, Jonathan, I think the last thing Powell wants to see is a huge increase in a substantial loosening in financial conditions, just as they're beginning to get their arms around the inflation, and they still have more to go to get it back to target.
So this is what Tom's been really leaning into, just the real rates argument. That keeps real rates quite elevated. David, how much of a challenge to valuations is that going to be, even as people start to get bulled up on the idea that a cut of nominal rates is bullish for equities?
I think, I would say we're not expecting, big gains in the S&P for the coming 12 months. Right, we've got our expectation is that we're going to see, roughly 5% gains, and we've had a very strong rally just in the last 2 or 3 weeks. So I think rates on the real side are going to remain fairly high, and I think what's going to be the more important driver here is going to be the fact that earnings growth should improve a little bit. That should support the market. But again, a lot of the soft landing at this point is largely priced in.
What do you do with cash over the next 12 months? Lighten up cash?
Yeah, Tom, I think there's a lot of opportunities out there in fixed income. I mean, you can go out the risk spectrum without taking too much risk. You can get a nice pickup in yield, in investment grade. You can, and if we get the fall in bond yields that we're expecting, then you get a pretty nice total return. So we have we have the 10-year going to 3.5 by the end of next year. So that's going to be, cash is going to have a hard time competing with that.
I mean, that's, Abramo's not here, but I got to ask Abramo a question right now. If you get a 100 basis point move in the 10-year full faith and credit, that's got to be joy to the world for agencies, MBS, and all the other derivative instruments. Am I right?
Yeah. We also like mortgages as well, MBS. So yeah, I mean, we've been sort of tiptoeing out on the duration curve.
Yeah.
But I think that would make a lot of sense.
Did I do okay there? Was that the edge of Abramo?
That was beautiful, TK. Did you see the headline that crossed the Bloomberg on the Bloomberg dollar index, Tom?
Well, Mohammed's buying QPR?
Erasing the gains for 2023. The dollar index wiping out the gains for 23, Tom.
Yeah, well, I think, currency is the ultimate litmus paper. And, John, I would just suggest within the broader spectrum, you can't have an international pop without weak dollar. I sort of subscribe to that maxim.
Well, let's get the international call. David, can we finish that? One thing that a lot of people got wrong, and this market's been so punishing and this economy is surprised in different ways. The US economy has been so much better than people thought it would be. And China specifically has been so much worse. Given how we've reset those bars going into 2024, David, what's the international call for next year for you and the team?
Yeah, so, I mean, clearly, China has been disappointing in terms of economic performance. U.S. has been better, as you said. But I also think at this point, that's largely reflected in their shares, right? You've got pretty full valuations in the U.S. You've got very depressed sentiment in certain countries in the emerging market complex. So we actually think that's an opportunity. We think that Chinese growth is going to stabilize, and just given how poor the sentiment is in some of these emerging markets, and especially China, that's an opportunity to us. Very different situation where I think a lot of good news is priced into the U.S. We think the U.S. can do okay, but have to be recognizing and cognizant of the high valuations.
Are you convinced by the charm offensive that came from Xi in San Francisco this week? Does that even matter? Is that relevant to your call?
No, that's not a big part of the call. I think it's going to be much more about the domestic policy measures that they are putting in place. I mean, clearly the property market is crucial in here, having some stabilization there. What they're doing on the interest rate side as well. So it's more about domestic politics. Look, I don't know. I think a lot of Western companies are really just fundamentally rethinking their supply chains and things like that. I'm not sure one meeting between two presidents is going to change how they think about diversifying and having some resiliency in their supply chains. That's I think a different story.
We've heard that a lot today already. David, thank you, sir. Good to get your perspective on things. Your view going into 2024. David Lefkowitz there of UBS Global Wealth Management. If you're just joining us, welcome. Equities are positive, up nicely. Session highs, positive 0.33%. Bond yields are lower by 3 basis points. The 10-year for 40.43. We talked about this charm offensive from Xi Jinping, pledging heartwarming steps to attract foreign capital, Tom, looking to create a, quote, world-class business environment.
The phrases were, managed, to say the least. But I get the dictator thing, and that was a big flap and all that. But to me,
be fair to Chinese officials, Tom, they shook that off.
Okay, but what's the signal he sends? I mean, with the defense secretary in the Philippines looking into 4 base build-out we're doing in the Philippines, forget about, trade agreements and all that. I think we're rebuilding out Marcus's nation. Fine, but what's really important here is what is the signal the Chinese send that they get the message the pendulum went too far? I circle back to Hong Kong. Maybe I'm wrong on that. I haven't had a lot of people pick up an agreement with me.
So what you're suggesting, Tom, and I think it's important, you can signal it from words, with words, but
or
ultimately
action.
You need to see action policy to get people to buy it.
And
Tom, some people might ask you, the train's already left the station. That David Lefkowitz's point, these companies are already thinking about moving, and they're doing that. They're re-engineering their supply chains, bringing them closer to home. We've seen so much of that from different companies. But I'm with you. If you really want to prove it, Tom, you want to attract that foreign investment again, it's not words that are going to do it. It'll be action.
It's action. And one of my essays of the year, and I'm sort of lining up the year, was a foreign affairs essay, which does Xi really have control over the cities and the lords of the Chinese cities? And that's a domestic issue that didn't come up in San Francisco.
We need to catch up with Anne-Marie, don't we?
We should.
Over in San Francisco. It's on the West Coast
Squeezing
in California.
it into a 6-day trip.
AMH is going to catch up with us next from New York. This is Bloomberg.
I thought was very interesting in the meeting is after the meeting, President Xi decided to have a dinner with a bunch of American CEOs who gave him a standing ovation. President Xi is desperate for American investment because he has made a series of economic decisions and political decisions, arresting people where capital is fleeing.
Capital has been fleeing. The outspoken Rahm Emanuel there, the US ambassador to Japan, speaking to Anne-Marie Jourdain at the APEC summit in San Francisco. Tom, we said at the start of the week, there are two stories in San Francisco that play out. One, you've got the meeting on the sidelines, as they like to say, between the two leaders, President Biden and President Xi. And then you had this gathering of corporate America and a Chinese leader. And we said repeatedly, because of that one data point and a bunch of other reasons as well, foreign direct investment into China turning negative, we would see a charm offensive from China's Xi Jinping this week. And that's exactly what we've seen. Tom, the words, and we have to separate the words from action because so far it is just words. Let's see if we get a change in policy. Pledging heartwarming steps, talking about creating a world-class business environment. You see those corporations, to Rahm Emanuel's point, Ambassador Emanuel's point, Tom, a standing ovation for the Chinese leader from corporate America. They want to be there. It's just been more difficult to be there over the last couple of years.
Ian Marlowe writing up the Anne-Marie Jourdain interview with the former mayor of Chicago. Anne-Marie was busy planning her trip to the Calistoga Food and Wine Festival.
Oh, is that taking place?
She's going out there. It's like 30 wineries up in Napa Valley. And
you've been to Sonoma before?
I've never been there. I
really
have
nice, beautiful part of the country.
I have it on my Apple computer now. I have Sonoma software. That's as close as I get. Joining us now, still in San Francisco, prepared for a tough weekend, Anne-Marie Jourdain joins us, Bloomberg Washington correspondent. And, you know, Rahm Emanuel really can cut to the chase. That's why Republicans and Democrats love him. And the ambassador from Japan in your conversation, Anne-Marie, really cut to the chase. The guy from Beijing was courting corporate officers of capitalistic America, standing up APEC at the same time. Discuss that.
Well, Rahm Emanuel, the U.S. ambassador to Japan, also a chief of staff to former President Obama, he's saying that China is desperate for this capital inflow to come back into China. That's the word he used with me, and he talked about this two-screen approach where President Biden left his sit-down with Xi Jinping and went and met with other APEC leaders, while Xi Jinping went and met with chief executive officers who paid money, big bucks, to sit at his table and to try to woo and dine them. Then what we saw the following next day is a written speech. Xi Jinping did not give this speech, he could not attend this other event, but a written speech where he talks about warmer ties and making it easier for businesses and foreign nationals to come and do business with China. So, like as Jonathan said, the proof will be in whether or not there is any action. But, and this is really to Rahm Emanuel's point, he wants to see that action and whether or not he thinks it's a safe place where businesses should go and operate. But Xi Jinping really did try to put on that charm offensive while he was here in San Francisco.
The simplistic mindset is the capitalists of the West will move their labor jobs to China and to the Pacific Rim. That's not good. Does this event that you've been at, does it move the bipartisan distrust in Washington?
I think the bipartisan distrust remains the same when it comes to China. And this was really the last moment Biden could sit down with Xi Jinping. As we head into an election year, we are 1 year away from the 2024 election. The rhetoric is going to get so much hotter. It's why I don't think, part of the reason why I don't think Biden shied away from, as he exited that press conference and took that ad hoc question, he didn't shy away from standing by his previous thoughts that Xi Jinping is a dictator. And I imagine you're going to hear that rhetoric start to amp up. So as the heat was taken out of the relationship this week, we've seen these détentes before and we've seen them derailed. So I think this is really about managing expectations and putting a floor in the relationship so it couldn't get worse. Not necessarily so it doesn't get much better, but so this relationship couldn't get worse.
You said it, I said it, Tom said it. Action's so much more important than words. Let's talk about action. Are we about to see the president go on TikTok? Is that what I read in Axios this morning?
Well, Axios is reporting that campaign is weighing this idea that the campaign should be on TikTok talking about President Joe Biden, because the fact of the matter is that is a really lucrative and easy way to reach young voters. That's where they are getting their news. The big issue this campaign is going to have, if they decide to go on TikTok, is the Republicans are going to go after them incredibly hard. I mean, we saw Vivek Ramaswamy, who called it social fentanyl, joined it for this reason. He says, I want to be able to make sure I'm reaching out to young Americans. But at the same time, you've seen a number of these Republican candidates say that it should be banned immediately. It should not be allowed to be downloaded in the United States.
I think we speak down to the youth of America on this and say, I'm going to call it collegially a purple state like Wisconsin. The People's Republic of Madison is going to show up, Anne-Marie, with the youth vote. Is there any indication the youth vote's going to show up and vote for centrist Biden versus their progressive theories?
Well, what we're seeing in the polling right now, and we just had a poll of these swing states, including Wisconsin, is that this recent conflict between Israel and Hamas, you see overwhelmingly bipartisan, many people in these swing state voters like what President Biden is doing, standing up for Israel. But when you ask the Gen Z, should he be doing more for Gaza, overwhelmingly they say yes. And they think more needs to be done for the Palestinian cause. And a lot of that has been trending on TikTok. This is probably part of the reason why the campaign is starting to weigh that idea of whether or not they should go on TikTok. They have in the past, the administration has in the past, used influencers, sat down with them for interviews because they knew that that content would end up on TikTok. So it's kind of a backdoor way into getting their message through TikTok. Now this is potentially them actually, signing up, having an account, something I know I don't have, I know Tom and John don't have, but actually signing up, having an account, and being able to reach these voters.
Let's wrap things up with a great trip for you, Anne-Marie, and thanks for your hard work over the last few days.
It's been okay.
Can you describe San Francisco for us? Because we've joked about it. We've had serious conversations about the cleanup act that took place under Governor Gavin Newsom. What's it been like there, Anne-Marie? What's it been like for you?
So it's been an incredibly difficult trip logistic-wise because, as you can see, there's all these fences around us, and I actually described it to someone yesterday as Pac-Man because you're stuck in a security zone, even your hotel, and every which way you have to turn to get around. So it feels like a security state in central San Francisco because President Xi Jinping and another number of world leaders are here. When it comes to the cleanup, a lot of the streets have been clean, but I've also seen a lot of messy streets as well. So I don't know. I'm going to go for a little bit of a walk today, and I'll have more to report on Monday.
The question here is, can Anne-Marie get to Gumps? I mean, you should see the fake Christmas trees at Gumps. I mean, they do it all.
What are they like?
Gumps is this fabulous department store in San Francisco, and they've been challenged with all the challenges in San Francisco. But I can just see AMH there picking out a tree a la Ferro, except it's got that West Coast Asian feel to it. Like
when I call you this weekend, like I always do, sometimes FaceTime. I'll make it a FaceTime this weekend. And I have that beautiful tree in the background, Tom. And you hear the Christmas music going, see some of those festive candles lit in the background. Isn't that going to make you feel warm and fuzzy?
I'm looking
out a piece of that.
I'm going to be warm. I'm going to look out the window at the truck coming up from the Carolinas going, those suckers are going to buy these trees. Can I say this? Jargon alert, Gen Z. I have no idea. Gen Z, John, is 1996. To 2010?
Yeah.
I didn't know that.
Yeah.
And we're informing every day here. I wouldn't call it Gen Z. I'd call that Gen tuition.
To that point, wait until they start, the old joke, Tom, wait until they start paying taxes.
Yeah,
We'll see how their views change. Anne-Marie, thank you. AMH, appreciate your time. Always do. Great work over the last few days. Next hour on Bloomberg TV, the brilliant Priya Misra of JP Morgan on this bond market, the excellent Lisa Shallitt of Morgan Stanley, Max Kettner on Goldilocks of HSBC. Stellar lineup going into the opening bell and coming out the other side. TK, this was wonderful. Loved being with you.
This was great. With Mohammed here, it's great.
It's just special.
I think QPR, they're in London?
They are West London, yeah.
West London, so on the way to Heathrow.
Yes.
On the way to,
if you take a bit of a
Chiswick?
Yeah. I mean, sort of near Chiswick, yeah.
Near Chiswick, okay.
Loftus Road. We'll make that happen one day, Tom. I've been there before.
Oh, yeah.
It's like one of those close, warm, old school stadiums.
It's like,
it's nice.
like Richmond.
It's nice, just like Richmond. Yeah. Just like Richmond. From New York City this morning, thank you for choosing Bloomberg. Good morning.
Bloomberg Surveillance on a Friday, quiet Friday, no economic data, not important economic data here. We're going to get to it in a moment with Michael McKee, and a real treat for all of you of Global Wall Street coming up. Professor Kelton, controversial on the state of our fiscal morass. That will be interesting to see, to say the least. Well, bond market moving 4.40 on the 10-year yield, and of course always moving off the economic data. Michael McKee here on a booming housing economy.
Well, that's actually pretty good news this morning if you want to see some housing work get picked up. At least housing starts up 1.9% during the month of October to a 1,372,000 annual rate. Building permits rise as well, 1.1% to a 1,487,000 rate. Both of those significantly higher than the prior month. The building permits number was negative 4.4 last month. So it does show that there is some work being done in private construction, in housing construction, and despite interest rates, builders are still putting holes in the ground.
Are they rich men's and rich women's statistics? Are we looking at housing now as only the province of the haves?
Not exactly. I mean, the big market is for first-time home buyers. And so what you're seeing is a lot of the builders cutting back on amenities in the houses, making the houses a little bit smaller so that they can bring down the cost. It's still very expensive for people to buy homes, and obviously home sales have not been extraordinary, but new home sales have been better than existing home sales because there is some inventory, and what we've been seeing is prices sort of flatten out for new home sales as prices are, as builders try to hold the line.
When does the mortgage rate on a nonlinear fashion coming from 8.03, I'll say, into now it's down nicely to 7.69, at what mortgage rate in your head does the animal spirit of housing rekindle?
I've asked a lot of Fed people that, and they don't really know.
We don't know.
This is a kind of a unique situation, but they're hoping maybe you get to something like 3.5%, 4%, which is going to take a lot of Fed funds cutting to get to that point where it might spur people to go back into the markets. There's going to be pent-up demand for housing and people who have to move because they're getting transferred or whatever. So some of the shelter-in-place psychology will go away. It just depends on at what point you can afford it.
One more question before we get to our esteemed guest, Mike. I really want you to participate with Stephanie Kelton. Is next week we get to Michigan, and around all this mumbo-jumbo that John and I have talked about this morning, there's this hope that we are not anchored or unanchored. In the Michigan confidence data and the expectation inflation data from there, can you detect if we're unanchored?
We don't seem to be unanchored yet, although the one-year numbers have gone up significantly over the past 2 months, which is a little bit odd because Michigan is usually correlated with gas prices, and gas prices have been going down. There is a theory that perhaps what people are doing is expressing their unhappiness with the overall level of prices, but it isn't affecting what they are doing when they go to the grocery store. They will have extra money that didn't go into the tank. They can buy more groceries, or they can buy more Christmas presents or whatever.
Mike, I want you to participate here because this is an important conversation. It is without question through the pandemic and literally over the last 5 years, she has had a greater influence on the debate of our American economics than anyone out there. Out of Sacramento, Cambridge, and a tour of duty at the very liberal New School of Social Research. Stephanie Kelton joins us now from Stony Brook University. The book is The Deficit Myth, and the three letters are MMT. Professor, honored to have you on Bloomberg Surveillance. Are we unraveled, Stephanie, the worry here of the annual interest expense, the return of a real interest rate? Are we unraveling as we roll into 2024?
No. I mean, the Fed is effectively, in a sense, putting fiscal policy, a big part of the federal government's budget, on autopilot. And it's really tantamount to running, a pretty regressive fiscal stimulus. That's what the rate hikes are actually doing. If we don't like it, Tom, there's a pretty easy way out of it, which is to say if the rate hikes are pushing up the amount of money the federal government is spending to service the debt, interest expenditure up by hundreds of billions and trillions of dollars over time. Remittances from the Fed to the Treasury have collapsed. All of this is adding to the deficit, which triggers more issuance of treasuries, which puts you in what is essentially just a cycle now of higher rates, higher deficits, higher debt, and it will continue for as long as the Federal Reserve holds in this position.
With the deficit, the debt and the deficit is from the new school Heilbronner and Bernstein classically talked about years ago. But the arch MMT criticism is you're handing monetary decision-making from the acuity and date-driven data dependency of a Fed over to the legislative branch. Can we trust the legislative branch to prosecute MMT given where we are right now?
Well, okay, I'm glad you mentioned Heilbronner. He was a professor of mine when I was there and a really terrifically bright person. Tom, MMT is a description of the monetary system that we have today. It is a floating exchange rate fiat currency. Love it or hate it, it's what we have. MMT describes the monetary system that we have and the mechanics of government finance. It's not a policy proposal. It doesn't propose changing anything. It's describing how things already work. So think about what Congress did with the onset of the pandemic, drafting first the CARES Act, that $2.2 trillion, and then the big omnibus bill, a $900 billion package. And then the Democrats came in and did their $1.9 trillion American Rescue Plan Act. All of that was deficit spending. We didn't give Congress any new permission to do anything. We just described how it all works. And it helps to understand why Congress was able to muster that kind of fiscal firepower when so many economists had previously said that when the next crisis came, we would be unable to act. People like Larry Summers said, because of the Republican tax cuts in 2017, that we would be living on a shoestring for decades to come. Those were his words, that we wouldn't have the ability to spend money because of the deficits, because of the debt. That was wrong. Congress has the power of the purse. MMT recognizes that, and MMT says, listen, this is an extraordinary power they have. They need to use it responsibly, and that means thinking before you move forward with bold spending programs about the inflation risk that's associated with those spending proposals. And that's the piece that was missing. The one thing you didn't mention in my, my tour of going through my education and so forth was the time I spent in the U.S. Senate as the chief economist for the Democrats. And I'll just say very quickly, and I'll stop, that when I was in the Senate, my great frustration was being surrounded by members of the Senate on both the Republican and the Democratic side who were drafting bills, $1 trillion of infrastructure, talking about Medicare for all and all these other things without ever mentioning inflation risk. I couldn't believe it. So MMT would have us do things very differently when it comes to the way we approach the federal budgeting process. It's inflation that you have to watch out for.
Stephanie, it's Mike McKee. If wishes were horses, then beggars would ride. The idea that Congress is going to think about anything before they start passing bills is probably not going to happen. So I'm wondering, after all this, is there a limit in the sense that at some point we aren't going to be able to respond fiscally for one reason or another to some sort of crisis because all of the money is going into debt payment instead of going into additional spending. And the way we're set up now, we got to pay those bills.
Okay, so two things I'll say. One, I've been hearing this my entire life. You'll remember that Chairman Volcker had interest rates up pretty high. And meanwhile, Ronald Reagan did 2 massive tax cuts and massively built up the military. So again, if Congress has the will to pass legislation, the votes are there, the money is there. And I'll just say, I don't think it's right to say, actually, that we can't trust Congress to rein it in. Remember, the so-called Inflation Reduction Act was Congress's effort to say, listen, we don't want to continue passing legislation given the inflationary environment. So we want to get revenues up. We want to control costs. We're going to negotiate prescription drug prices. That was all Congress taking, careful steps, I think.
Would you suggest, Stephanie, whether it's a Republican or Democratic two houses, that we can have budget responsibility? Do you see displayed budget responsibility in the modern Congress and Senate?
Well, Tom, what I'm saying is that if we were doing things the way I'd like to see them done, instead of handing proposed spending bills to, let's say, the Congressional Budget Office and saying, give me feedback on this legislation I have drafted, tell me if it's going to increase the deficit, tell me whether it adds to the debt, I don't think that is the most important feedback. I think it would be much better to have CBO and or other agencies evaluate proposed legislation on the basis of inflation risk, but we don't do it that way.
Right.
So I think that would put us much closer to having a Congress that operates with fiscal responsibility, i.e. inflation risk, at the heart of what it's doing.
Can you and, say, a critic of yours, John Cochrane, the great conservative economist, can you and John Cochrane get on the same page and say we need a Simpson-Bowles redux, where in the initiation of that panel, we actually demand that we get something done?
No. Sorry, but no is the answer to the question. You would have to first convince me that there is some sort of looming crisis that necessitates the formulation of a fiscal commission, and I don't believe that we are facing that kind of crisis. Inflation is coming down. So if you approach things the way I do, which is to say, are we at risk? Is the budget posing an inflation problem? Then let's get at it and let's figure out what adjustments need to be made to ensure that we aren't putting ourselves at risk of entrenched inflation well above the Fed's target. I don't think that's the future we're facing.
Fascinating and controversial. Professor Kelton, thank you so much. Stephanie Kelton, I can't say enough about how refreshing to any and all her book, The Deficit Myth, is. She is at Stony Brook, and you know her from the phrase MMT. Our phrase is to do a data check. Futures up 12, Dow futures up 126. VIX, nicely under 14, 13.89. A stunning statistic. The 10-year yield, 4.43%. The Standard & Poor's up 0.2%. We welcome all of you here, Bloomberg Surveillance, and after that controversy, I could feel the heat come up in the room. I mean, our technical staff was like, Kelton, a debate there. I mean, what a raging debate. And, I tried to be collegial and go to Simpson-Bowles as a political solution to what Pete Peterson and Paul Tsongas, and she said no. I mean, that's the polarity.
I think MMT obviously controversial, but perhaps the most controversial thing she said is that Congress could do the right thing. Because to paraphrase, to turn Winston Churchill's saying on its head, Congress tends to do the wrong thing only after trying all the right things. Well, and they end up in the wrong place, which is unfortunate.
In the heart of this, and Blanchard talks about this, many others as well, is I'm going to say, Mike, 3 tranches of stimulus. We actually got a Kelton during the pandemic, and we're watching am I right that we're watching an experiment in MMT in real time?
Well, MMT is hard to pin down, as even Stephanie admitted, but we're certainly watching an experiment in how far you can go with fiscal policy in real time.
Yeah.
Interesting question is, she said before the Congress does something, they should think about the inflationary impacts. And certainly there were some people who were, Larry Summers one, talking about that. But in general, people didn't understand the inflationary impacts because this was a pandemic situation we'd never had before. So would that work the next time?
Michael McKee here, off of Stephanie Kelton. That's what Bloomberg Surveillance is all about. There's no question the yield space is front and center off of a Magnificent 7 bull market. Coming up, Ira Jersey on bonds. Good morning.
We still lack one of the 3 anchors. You either need an economic anchor, or a policy anchor, or a technical anchor to the bond market. And we've lost all 3. So these moves are going to continue. The thing that has really impressed me is that nothing has broken. If you had told me a year ago we're going to see this incredible volatility in the most important market in the world, is the benchmark for so much else, and yet nothing will break, I would have said that's impossible.
El-Arian, inflammatory comments there. What a wonderful effort to be with 2 hours with Mohamed El-Arian this morning. He is with the University of Cambridge in their Queen's College. And of course, years and years, a student on the market. Mike McKee gave us a little hint, publishing next week, I'm told. One of the things, we can't release what it is. It's on a need-to-know basis. Michael McKee here, because nobody loves me. Bramo's gone. Ferro's gone.
I'm very fond of you.
The loyal McKee here to provide perspective.
We've been doing this
huge
for a long
response.
time.
Thank you for the emails, and I should say the hate mails on Stephanie Kelton. Always controversial with more mainline media. Of course, what we're doing here, and this is within the bond market, it's a new School of Social Research half hour with Professor Kelton, and now joining us, someone else with Parchment. From the new school, the data check, futures up 10, yields stunning, 4.43%, and he's out with his view to next year. Ira Jersey, interest rate strategist for the new School of Social Research and also Bloomberg Intelligence this morning. Ira, does the debt and the deficit of Heilbronner and Bernstein, the high point of new school economics, does the debt and the deficit intrude or make harder your view for next year in bonds?
It does, because supply matters, right? So that, the basics of economics and markets don't stop because you have, a theory like MMT. So given that we're expecting a $1.7 trillion deficit in the current fiscal year that ends next September, the supply side is somewhat worrying and making it somewhat of a challenge as to where yields might go in various states of the interest rate market and the economy. That being said, with the House view that the economy is going to be much slower next year than it has been on both a real and nominal basis. So inflation coming down and real growth being kind of anemic over the course of the year, we do expect 10-year yields to be 100-ish basis points lower than where they are now. To
cut to the chase and what our audiences want to hear, it's a double-digit Ira Jersey. I mean, you mince no words about it. Nobody's clipping a coupon. It's time to make money. What strategy, what duration allows for a 2024 double-digit return?
Yeah, so if you go out, even 5-year notes might even have a close to double-digit return, because if we're correct, then you get a 1% reduction in 5-year Treasury yields at a duration of more or less 5 years. That's a 5% return plus the 4.95% return that you get on clipping the coupon. So you get pretty close to 5%, even being in the belly of the curve. But the farther out you go, that's where you get more bang for your buck. So it really depends on your risk tolerance. However, Tom, as you know, we talk about duration and interest rate risk all the time. You go out to a 30-year bond. If you're wrong, right? If we're wrong, you can lose a lot more money in a 30-year than you can in a 5-year. So that's the risk reward profile. I think kind of favors the belly to 10-year sector of the curve as opposed to the 30-year or even the 2-year.
It's like a Chinese wall at an institutional firm, a Wall Street firm. We have the surveillance wall where economics never talks to fixed income. Michael McKee with us to help out with, Ira Jersey.
I talk to Ira Jersey all the time. We have a different kind of relationship there. You mentioned the 30, Ira. I'm just curious, as we go into the week after next week being the holiday, nothing's going to happen, but then we get another round of coupon sales. Do we think we're going to get the same kind of problem with the 30? I'm reading that the Treasury Department certainly doesn't think that there was any ICBC issue that caused the weak auction for 30s last week. Does it recover?
Well, so the auctions we get we get after Thanksgiving are the 2-year, the 5-year, and the 7-year. I think firstly there was a lack of demand for that 30-year bond duration, and I think some people were distracted maybe by what went on with the hack. But I don't think it was people worried about the market structure and actually the functioning of the market that really did in that weak 30-year. But remember, the 10-year auction was really good. So I think it's just that people are willing to take risk in the 10-year, and the 30-year, they just at the time weren't willing to take risk. Now, that being said, I think 2s, 5s, and 7s, they probably come and go. But at the next round of duration auctions in mid-December will be interesting because it'll be right before the Fed meeting, number one. And number two, we're going to get, before we get some of those auctions, we're going to get the next CPI plus the next non-farm payroll, the ISM data. So we have a whole slew of data. And I think that, whether or not 10s and 30s get bought or avoided a little bit in December really will determine the pace of that data. So if that data is weak, I think you can wind up having reasonably strong auctions.
Well, you mentioned the data and the market reaction to that. I'm curious as to your reaction to what Mohamed El-Erian said earlier on the show about the market not having an anchor anymore, that we've blown through we've blown through the economic anchor and the policy anchor and the fundamental technical anchors. Is that really the case? Is the market really kind of drifting without a guide?
Well, I think that, the idea of having, market anchors, I think part of this is the uncertainty about the future of monetary policy and growth, right? So when you get a lot of uncertainty, you do get heightened volatility in the market. And I think that's one of the things that you saw over the last 2 months or so, basically since the end of July, with the sell-off in treasuries, was an acknowledgement that if we are going to have an anchor, and that anchor is kind of coming unleashed a little bit, which is what you saw when Jay Powell and the Federal Reserve decided that tried to convince the market that they weren't going to cut rates next year. That's when you really saw the sell-off. So I know some people are talking about it being a supply. About 90% of that, we estimate, really came from the shift in monetary policy expectations. So I think the anchor still exists. It's just that anchor maybe needs to find a new catch on the floor of the seabed there.
With price up, yield down, not so much what does cash do, but what does this titanic shift we see from deposits to money market funds do?
Yeah, so that's one of the reasons why T-bill auctions have gone pretty well, and that the Treasury Department's been able to issue a whole lot of T-bills. We have a chart in one of our reports this week. I don't remember which one we published so much this week, but we have a chart showing that just the massive increase in the amount of T-bills outstanding over the past 5 months. Those have been able to be absorbed because of the shift from deposits into money market mutual funds, and so I think that's almost necessary in order to fund the government. Now, the banking sector in aggregate has enough reserves right now, and we have enough money in the reverse repo facility that another $200, $300 billion of T-bills can come out without too much problem, and probably will be absorbed. Much more than that might get a little bit dicey, because I think there is certainly a floor of how many reserves banks need to hold, number one, and then number two, I also think that there's a floor for how much money market mutual funds want to hold at the RRP facility, because it's just easy. It's you're facing the Fed, so the chance of default is nothing, and it's daily liquidity that these money market funds need.
Ira, thank you so much. Ira Jersey with Bloomberg Intelligence on fixed income, and the consensus view here is in 100 beeps-ish. 450 into 350. I'll believe it when I see it. Final thoughts here with Michael McKee, always advantageous. A little bit of data today, a lot of data this week. Seismic change, I guess, is what I saw. How ex post right now is the Fed? To me, maybe they've never been this far to they have to wait for the data. They're massively ex post.
Been a very long time. I mean, they've said we're data dependent for years and years and years.
But now it's with a vengeance.
They really are, because the models don't work in terms of predicting what's going to happen in the future. They think they know what's going on, but they need to be sure. They want to make sure they don't make a mistake.
So what's the path to December? I believe it's 13th look like, other than I will not have my Christmas shopping started by then.
Well, we'll take a look at the PCE inflation numbers at the end of the month and the spending numbers, and then we get CPI the first day.
Does Jobs Day matter? Come on, you're all right here. Come on.
Jobs Day will matter, but the inflation numbers are really what's driving things now. And if the Fed sees that, unless we get a huge jump or drop in unemployment, it's going to be the inflation numbers. If the Fed sees inflation continuing to go down, they'll hold off. They don't want to, as I said, make a mistake and go too far.
Michael McKee, thank you for joining us here on a new school of social research half hour. That's what we do for Manhattan here. Green on the screen, a little bit of red. NASDAQ fractionally south, up, futures up 8. The VIX speaks of the week. The VIX in under 14 and optimistic, a bull market 13.98. On the open with Jonathan Ferro, Priya Misra.